And the wait begins live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to the closing bell here in the U.S. with about 2 hours to go. Here's where we stand. We have a rally on our hands. You take a look at the S&P 500, up about 0.9%. Big tech up even higher, really powering the indexes higher. The NASDAQ 100 up by about 1.7%. Of course, it's an interesting week. We have a lot of risk events coming up later in the week. Right now, it looks like we're rallying, and that's as that bond market rally resumes as well. You take a look at 10-year yields, currently lower by about 5 basis points. We are back below 4%, but just barely. It feels like 4% really is a magnet here. And I did want to point out Bitcoin because it is really on a tear, breaking above $47,000 a coin. Of course, we have the potential approval of U.S.-listed spot Bitcoin ETFs remain, and anticipation is high.
All right, that'll be potentially a big story here on the week, assuming that it actually does happen. You see the price action there. You also see the price action on the broader market with the S&P 500 in the green today by a pretty wide margin, but some notable drags out there to keep an eye on over the next couple of hours. That includes Boeing. The plane maker stock right now is the biggest percent decliner in the S&P, second biggest point drag after ExxonMobil. Aircraft component stocks also lower as well. The Boeing MAX 9 jet now grounded for inspection after that mid-flight blowout that we all saw of that unused emergency exit door on an Alaska Airlines flight this past Friday. Boeing shares on the back foot, but it's really the shares of Spirit Aerosystems that are the ones to watch. Spirit, which makes the fuselage for the 737 MAX, saw its shares drop the most going back to at least August of last year. Its bonds weakening the most since April. Meanwhile, it is a pretty good day out there for apparel stocks. This after several retailers seem to add fuel to this argument that the consumer here in the U.S. is doing just fine. Lululemon, Abercrombie & Fitch, American Eagle, and Crocs each raising their sales outlooks today. That's ahead of the big ICR conference this week. Abercrombie saying the better than expected holiday sales, that's going to help it meet its 2025 financial targets ahead of schedule here in 2024. American Eagle said the holiday momentum has continued into early January, and Crocs says it expects to report record 2023 revenue after a successful holiday season. Crocs shares rallying the most since April of 2020. American Eagle having its best day going back to early 2023, and Abercrombie & Fitch poised to close at a record high. Now, while the individual stock stories catch the headlines on this second trading week of 2024, those individual stories are painting a new macro picture, a picture, Katie Greifeld, still focused around expectations of, well, what central banks are going to do. And after last week, I wonder if anything different is happening this week.
Well, you take a look at what's being priced in right now. At this chart behind me, this is really what's been driving the markets, at least when it comes to that equity benchmark level. Right now, we have about 145 basis points of cuts priced into 2024. That is just under 6 quarter-point cuts priced in for the whole of 2024. We've seen some pushback from Fed officials. It's going to be really interesting to hear that, whether that continues in the next couple of weeks. But this really has been the center of the market's mind. Of course, as we entered into earnings season, once again, it never ends, but it starts again this week with the big banks coming on Friday, whether the earnings story can overtake the macro narrative. We don't have too much to look forward to this week and next week, but then we really kick off with the crescendo coming the week of January 29th. And again, those individual stories, they add up into data. We'll see if that can really take center stage when it comes to market psychology.
All right, let's kick things off to the close here on this Monday afternoon. Brian Weinstein joining us, head of global markets over at Morgan Stanley Investment Management. And Brian, you just heard the rundown that Katie gave us there. A lot of questions here about whether the fundamental backdrop is actually supportive of some of these elevated prices.
Well, it certainly is more so than it was, 2 months ago, right? It's amazing what 125 basis points of lower rates can do and pricing in all those rate cuts. So I think you're getting there. I think we're at the beginning stages now of the Fed calibrating interest rates, which means if growth is a little bit lower, well, the Fed can ease and it'll make people feel better. And so I think you're in this little bit of a Goldilocks stage where, yes, risk assets can continue to move higher because there are a lot more tailwinds than there were when 10-year notes were up above 5%.
Is this a situation, though, where we are still going to be paying attention to what's happening in the fixed income market and how that feeds through into equities? Are the correlations, or the negative correlations, I should say, still that strong?
I think they're there. I think they're weakening, to be honest, right? I mean, 10-year notes seem to be stuck right around this 4% range. I get, December and January markets get a little bit strange. So 10-year notes got to, 375 in December. That's a little too low. 410 last week, probably a little too high. But I think if fixed income markets are just boring, right? If we just don't react that much, it means that people are going to move money to equities. If your money market fund, which yields 5.25 today, you think it might yield 100 basis points lower in 6 months, you're going to start thinking about moving that money outward. So I think the bond market matters and the correlations will stay the same, but I think they're fading.
If fixed income is boring, Brian, it feels like the bond market hasn't been boring for a while now. It's really been the epicenter of volatility, especially when it comes to the past year or so. Do you see that sort of changing, that dynamic where it's the bond market that's been the most volatile?
I do. I mean, listen, we're still going to react to CPI coming out later this week because the Fed keeps telling us every CPI matters. I'm not sure that's true, right? I think the story of CPI evolving back towards 2% matters. Whether or not we're a tenth or or not lower or higher this week probably isn't as important. So you'll get these bouts of volatility, but I do think the market is dead set on believing the Fed is going to ease. I don't think a lot's going to change that view, and I think as the bond market gets boring, it'll push volatility into, well, first everything will calm down and things will do well, and then I expect volatility to end up in more name-specific and probably more in the equity markets later on in the year.
Well, on the topic of rate cuts, I want to go to this line in your notes. Beware thinking that an early Fed ease is good for risk assets. Let's talk about that a little bit more, because as you saw, that aggressive rate cut pricing in 2024 and getting pulled forward as well, of course, that's been a green light for risk assets. Why should we think twice about that?
Listen, I think the danger is for the next couple of months, inflation is going to continue to fall towards that 2% target. But financial conditions have eased so much that I think that there's a risk that we never get all those rate cuts. And in fact, we can get higher interest rates in the back end of the yield curve later on in the year. And that, I think, would put a damper on some of the interest rate sensitive sectors, technology. If the Fed is seen as being too easy in a world where inflation is going to bounce back up after it starts to fall, I think risk assets can do worse. It's not a story for today. But I do think we should be careful thinking that soft landings are easy and obvious and that the Fed can engineer whatever it wants here. It will get more difficult later on this year.
Does that sort of require, I can think, a more defensive stance in this market then, if you believe that?
Yeah, listen, I mean, I think you will see leadership change. Everyone always expects the story to be totally different in January than it was the year prior. I don't know if that's going to happen. I mean, the Magnificent Seven still have plenty of support and for good reason. So, but I do think you can see other equities rally. I do think being more defensive will pay off later on this year. But that's not today's story, right? When the Fed starts talking about no more QT, right? They're going to stop shrinking the balance sheet, talking about easing. The first order effect, people are going to move money from money market funds into risk assets. I think the volatility and the price to pay comes later on in the year, but we should keep an eye on that.
On that move, though, I mean, coming out of money markets and other sort of short-term assets that, let's face it, yielded, at least for some of us, a once-in-a-lifetime opportunity here. I mean, how swiftly do you think that transition will be, assuming that rates don't come down materially? Say we go from 5% on a money market down to 4%. Is that really going to shake a lot of people out?
I think it will start to move people, right? Especially if I'm right and inflation starts to tick back higher later in the year, right? So if inflation, listen, I think what's really interesting about what the Fed did is that they are starting to let us price in eases, knowing that inflation is not going to fall well below 2%. So to me, that tells me inflation is probably, the Fed is targeting inflation kind of 2% and a little bit higher, maybe up towards 3. So your 4% yield, it's nice to have, but it gets a little bit more painful if inflation ticks higher. I do think it matters if your money market fund goes down 100 basis points in yield and money will move out. But to your point, it's not a rush, right? People aren't doing it today. It's just something to keep an eye on. And I think the marginal dollar will start to move from money market funds into equities, and we really haven't seen that happen yet.
Well, let's talk about this a little bit more. Okay, let's say the bond market gets boring. You do start to see some of that cash exit money market funds, maybe go into more defensive spots in the equity market. How does big tech fare in that environment?
I think big tech does okay. I mean, I think at times it will lag and should lag some of these other sectors. I mean, obviously in commodities and energy, it depends a bit more on specific dynamics. But if you think about more industrials, utilities, or more the consumer staples, where people were so worried that the consumer was going to be weak, I think at the end of the year, tech will have done a little bit worse than the index, but I still think it's such a huge part of what people are buying. It's hard to see it falling by the wayside completely.
Brian, always great to talk to you. Brian Weinstein there, head of global markets over at Morgan Stanley Investment Management, helping us kick things off to the close here on this Monday afternoon. A lot of big stories to cover today, including Boeing, the worst performer in the S&P today after that frightening incident of that 737 MAX 9 jet, that Alaska Air flight where you see part of the fuselage coming detached. We'll have the latest on the U.S. government investigation.
Plus, 2023 was a rough year for M&A deals, but will things get better in 2024? We'll get insight from Robert Profusik, Global Chair of M&A at Jones Day.
And international container shipping stocks on a roller coaster ride today. Reports that Maersk had struck a deal with Houthi rebels about potential safe passage in the Red Sea. The company pushing back on that report. We'll have the latest and so much more in just a second, right here on Bloomberg.
Next week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As markets anticipate a dovish pivot by central banks, policymakers grapple with two wars on the global stage, and AI continues to dominate the tech headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
All right, let's get to the latest on tensions in the Red Sea. Shares of Maersk and Hapag-Lloyd falling after the shipping companies denied being part of any talks with Houthi rebels about potential safe passage. A spokesperson for Maersk telling Bloomberg, quote, "Of course, we do not enter such an agreement." Bloomberg Intelligence senior transportation and logistics analyst Lee Klasko joins us now for more. And what does that mean? Okay, let's say that there's no safe passage guarantee, no such agreement. These tensions continuing. What does that mean for these shipping companies and their share prices?
Well, if there's no agreement, and we don't think there would be an agreement because the Houthis are a terrorist organization, but assuming that the Suez Canal was fully opened and ships could operate safely, that would have a downward pressure on rates, especially as it relates to the container liner industry, which had extremely depressed rates, and so they got a super big boost when all of the risks started percolating in the Red Sea, and that's really driven because ships have to take a longer time to be rerouted. So instead of going through the Suez for freight from Asia heading to Europe, shall we say, now it's going around Africa, and that's adding anywhere between 10 to 12 days. And if you're going to the East Coast of the United States, it's adding even more time. And so, what that is going to do is suck up a lot of that slack capacity that's out on the water and put upward pressure on rates. We've seen rates, depending on the lane, going up 200 to 300% since their October lows, but the reality is they're still, call it 80% below their highs that we saw in 2021.
How plausible, or maybe the flip side, how crazy is it to think that there are some shipping companies, major shipping companies, I should say, that would be willing to sort of enter into some type of safe passage agreement with the Houthis?
I mean, I don't think any large publicly traded company would even think about it. Maybe one-off individual ship owner, maybe it's possible, but highly not probable, especially because you might have to deal with going up against U.S. and its coalition that are trying to kind of tamp down any activity that's going on in the Red Sea as it relates to the Houthis.
Yeah, perhaps the risk reward just isn't there. Let's talk a little bit about shipping rates. They're higher, and that's been the narrative, that's been a benefit for these companies, a silver lining, if you want to call it that. What about demand? Are we anticipating any slowdown in demand due to this situation?
No, this isn't really going to impact demand. I mean, demand's going to be the same. The only demand shift that we might see is that if some shippers are like, hey, it's going to take me so much more longer to get my shipments to call it the United States, they might decide to use air freight instead of ocean. So you might see a mix shift, or you might see certain shippers looking for all land bridges where it's possible, as opposed to going on the water. So you could see a market shift away, but I think that's not going to be really material. It might give it a little boost to the air freight market, which is in much better position than the ocean liner market, and it could drive also rates higher in those markets, which will also help the freight forwarders out there. Freight forwarders are people like DSV and Expeditors. Those are some publicly traded forwarders. But at the end of the day, it's really not going to impact demand. Demand is really global GDP growth. So you're calling it low single digits, and that's probably where we're going to stick. It's really on the rates aspect, and a lot of these liners aren't expected to make money until the second half of 2025. So this short-term benefit might mitigate the losses that many analysts are expecting in the first quarter, but they still might be pretty hard pressed to turn a profit. And really, it's really going to depend on how long the issues in the Red Sea and what's going on with the Houthi rebels and their risk to global shipping are going to have. I mean, the U.S.-led coalition, you would hope they're going to start either doing convoys or something to have ships safely transfer across the Suez Canal.
All right, Lee, a lot of moving parts here. Really appreciate the update. That is Bloomberg Intelligence Senior Transportation and Logistics Analyst Lee Klaskow. And of course, Romain, you add on the fact that there's a drought underway in the Panama Canal, and it's just very difficult to move goods around the world right now.
Yeah, I mean, this goes way beyond just the Red Sea here. I mean, you have at least 3 major choke points right now in international shipping waters, all for 3 different reasons, but it's significant. And we talk about these attacks. I mean, it's something like 24 ships, I think, that they've tracked that they know the Houthis have attacked directly.
Yeah.
And that's already diverted how many countless dozens and dozens of ships here. That's raising the cost. And then there was a lot of discussion about with the Chinese Lunar New Year coming up, and a lot of concerns about whether the capacity was going to be there for both outbound and inbound shipping in and out of China. I think that starts like the first or second week of February.
Yeah, a lot of open questions here, and of course we'll be monitoring this closely.
Yeah.
But coming up on the close,
Remember, like a couple of years ago, I remember it was Tracy Alloway, and she charted the cost to get her goods from. She was living overseas in the Middle East, and how much it was to ship back here. And of course, it sat out there. It took a while. Yeah, it took several months here. I'd be interested to sort of recreate that again.
We could do it. We could do it. We'll follow up on that after the
someone
show.
better than us.
Someone will do it. Someone will. Coming up on the close, more on the tech rally leading U.S. stocks higher. We're going to talk about that with David Bellan of Citi Global Wealth next. This is the close on Bloomberg.
All right, big tech leading stocks higher today. Well, and that's probably how it should be, or at least that's the expectations for a lot of investors heading into the new year. David Bellan is the global head of investments and chief investment officer over at Citi Global Wealth. Curious to see what he thinks about the latest leg up here in tech stocks and whether it is going to sustain itself deeper into 2024. And that really is the big question, David. I mean, a lot of people wanted to see a broadening out of the rally. We got some sort of sense of that towards the end of the year, but at least for right now, people seem to be gravitating back to big tech.
Yeah, look, big tech was the story of 2023. When you have 10 stocks generate 2/3 of the gain of the S&P, that's big news. Now, I think what we're going to see is a broadening out, Roman, both of the interest in technology and in growth shares in general, and that I think is going to be aided by lower interest rates, which they're particularly sensitive to. But what we're going to see, that's even more exciting from an individual investor standpoint, is really a broadening out across a variety of different sectors, some of them defensive like healthcare, some of them more interest rate sensitive like biotech, even industrials. I think as we get toward the end of the year, you're going to see a much broader market. And I think that, day to day, you might see a day like today where technology is doing great. But what really will be the story of this year in our minds is simply how many stocks will outperform the expectations in 2024.
Well, give us a sense. Are there certain pockets, certain industries that you think maybe have a lot more of a runway than others in terms to the upside, that is?
Sure. I mean, I think, the normalization of the yield curve, I think, is going to help financial stocks, and they're going to do, I think, better than people expect this year. I think the alternative investment managers that do private equity and other alternative investments are going to have a very good year. Why? Because they're going to be benefited by lower interest rates and higher volumes of IPOs and more business activity in general. I think different parts of the infrastructure for example, warehouses, right? We're building lots of industrial properties. What's going to fill them up? A lot of semiconductor manufacturing equipment, right? From companies that, and so the companies that make that equipment will do well. And many other small and medium-sized growth stocks that really have yet to participate in the rally are going to be beneficiaries here as well.
So, David, maybe a broader rally with more participation is what we have to look forward to in 2024. Does the leadership within that broader rally necessarily change?
Yeah, I mean, I think we've already seen that at the beginning of the year. And even though today is a great day for technology stocks, the fact is that, history doesn't repeat itself this closely. In other words, it's highly unusual to have 2 years in a row where a handful of companies lead the market. In 50% of cases, the equally weighted S&P outperforms the market-weighted S&P. And that's important for people to know, right? 50% of the time, not just a little bit, and that's what I would have thought before I saw the data. So that's one of the reasons why this coming year is much more about broadening. And there are going to be other sectors, some of which I've already mentioned, that I think lead their way out of there. One of them, as I mentioned, being healthcare, another within it, biotechnology. I think, the whole area of cybersecurity, which is, part of the tech market, but, part of the software market too, which is yet to, again, have the explosive growth that we saw in tech share prices last year.
Mm-hmm. So listening to you talk, I mean, it sounds like a pretty good year that we're looking forward to. But when you talk to your clients, what are the lingering concerns out there? What are people worried about?
So I think that watching not your program, but other programs, you get this fear that people have that somehow that recession is still in front of us, which I think is completely not happening. We're not going to have a soft landing or a hard landing. We're not going to have a landing. We're actually going to have a reacceleration across the economy later this year. I think people are worried about inflation, right? They have it in their heads that inflation is going to be there. And we have all of these indicators, from declining energy prices to declining housing prices to declining import prices, that tell us that inflation is not going to be a big deal. And right now you have this temptation to stay in cash, which, when people are getting paid 4 or 5%, they think, wow, I've got that's a great return. Not only on an after-tax basis is it not a great return, it doesn't lock in the higher interest rates that you can get for longer by moving to intermediate bonds, but a lot of other, areas of the market, whether it's mortgage securities or structured securities, where you can earn, in the high single digits, and you should be locking in those opportunities now. So I think there's a fear factor and almost a disbelief that we somehow could be really out of the woods, and we definitely are on the other side of what I think will be, a good economy in 24 relative to even there in 23.
All right, David, always great to talk to you here. A great way to start off the new year. David Bellan, he's Global Head of Investments and Chief Investment Officer over at Citi Global Wealth. Here on a Monday afternoon, Katie Greifel, where stocks are really trying to claw back some of the losses from last week. A pretty powerful rally for the NASDAQ, up almost 2% on the day. S&P up 1%, and even small caps getting in on the bid, 1.5% higher on the Russell. Everyone's singing in unison, and it sounds pretty bullish. Pretty amazing to watch the S&P 500 reclaim those session highs. We'll see if that continues. Again, we have a lot to look forward to at the end of the week. A bid coming into treasuries here, pushing yields down across the curve, and a big bid coming into crypto and Bitcoin at 47,000. Stick with us. This is The Close. This is the countdown to the close. Let's get a quick check here of the market. Just about 2:30 here in New York, with most equities here getting a pretty strong bid. Treasury's getting a bid as well. You're not seeing much of a bid coming into the commodity space. As we wait for settlement of NYMEX crude to cross the wire, we're looking at a 4% decline right now at the moment, back below that $71 level. A lot of concern right now about some of the physical prices that we're seeing coming out of Saudi Arabia, suggesting that what the market has been talking about for quite some time now does appear to actually be manifesting, and that is a significant drop in demand and certainly the prices that some folks are willing to pay. Gold futures taking a leg down here on the day, and aluminum futures down as well. There was a bid a little bit higher in the day out of London, but that faded pretty quickly and reversed. And wheat futures also lower here on the day, a 3% decline coming out of Chicago. Concerns there about supply outpacing demand. All right, let's turn from the commodity space and go back to the broader market here. It's a big Monday for M&A, with more than $6.4 billion in healthcare deals announced today. Now, the strong start to the year, it comes after deals declined by about 40% last year, hit by higher interest rates, economic uncertainty, and antitrust regulations. Let's get some idea as to whether 2024 will be much different. Jones Day is a behemoth of a law firm, and it has a behemoth of an M&A practice. And the man who has led that practice for years joins us right now, Bob Profusek, Global Chair of M&A at Jones Day. Great to see you here, Bob.
Nice to be here.
I listed it here in the intro here. Last year, it was all about the cost of capital, regulations, and, of course, obviously, the state of the economy. Are those three factors going to be the main factors in 2024 as well?
Yeah, you know, when you stand back from the last 3 years, it's really been extraordinary what has happened. I mean, we had the pandemic. We had this incredible run-up afterwards, both in the equity markets and the deal market. M&A almost hit $6 trillion in 2021. Then we had, and we should have probably foreseen it, inflation for the first time in over a decade. Mm-hmm. Now we had the Fed. Now we have, when we've had war, we've had just an amazing amount of things that have happened. But, you know, transactional activity is pretty durable. Now, it was slow last year. There was a period right around the end of the first quarter going into the second quarter where financing was, you had to be a AAA credit to get anything. You had to not need it if you wanted it. You know, it was that sort of thing. So that slowed things down. And all of those factors are key. But, you know, M&A isn't just... It's something that's kind of strategic, and it depends on who, you know, what company you are. You know, even big, very stable companies have to grow, and they want to have a multiple that is faster than their intrinsic growth rate, their intrinsic, you know, EBITDA growth rate. Only way to do that is to buy something, synergize it, make it more profitable.
I'm curious, though. I mean, you've had a long career in this. You've advised hundreds of people on deals over the years here. What people are concerned about now in terms of either getting the deal done or even just putting the deal out there on the table here, what is the biggest concern right now? Is it the cost of capital, or is it the regulatory environment? What?
Well, it depends on the circumstance. You know, we've seen, as you mentioned, we've seen a spate of
healthcare
pharma deals.
Yeah, pharma.
Well, they have to do that. You got to replenish that pipeline as your patents are going down. So that's just a constant. Plus, they have balance sheets that, well, they don't really need to borrow very often, and if they do, it's at good rates. It really depends on where you are. Big companies doing horizontal transactions, meaning you're in the same business, they're very hard to do. EU is very hard right now. We being Americans, we focus on the FTC and Department of Justice, but that's like child's play compared to the EU. And the EU is coming up with these odd theories of what's competition, and is it, you know, it spilled over a little bit to the FTC, but they're talking about non-competition things, effect on communities, effect on workers, and all that. What's that got to do with it? So big horizontal deals are hard to do, but there's a lot of them being looked at right now because of this need to reposition, accelerate your growth rate, and fund the premium you pay with synergies, you know, reductions.
And we keep talking about this higher interest rate backdrop, how that's really, you know, tightened up the type of M&A that you're seeing. It's also tightened up the IPO market as well. In that environment, how are the deals that are going through, the M&A that is happening, being financed? Have we seen a move to cash? How is this working?
Well, a lot of people have a lot of cash. And one of the things that happened after the regional bank crisis in the first half of last year, I'm not sure crisis is really... I mean, it was
something.
But is all of a sudden you got all these alternative lenders coming in, and they're not like, you know, these aren't people with loan sharks or anything. This is big, major financial institutions: Blackstone, KKR, GSO, which is part of Goldman Sachs. All these people, and they said, well, if you banks aren't going to finance, we'll do it. And the good thing is, the interesting thing is, they'll participate. Senior, subordinated, preferred. You know, they have all sorts of places they'll go. Cost is a little bit higher than a normal bank loan. At least it would be in a prehistoric period when we had no interest rates, practically speaking. But that just goes into the multiple. It mixes into the whole thing. So now the banks have started lending again. They now have some competition with this private lending, and I don't think that's going away because. You know, these are huge organizations with access to lots and lots of capital and able to attract investors who need high-ish fixed returns.
Yeah, it's going to be fascinating to see how private lending develops. But let's talk a little bit more about industries, about sectors to watch. You mentioned pharma, for example. Is that the one to keep an eye on, or are there any other industries that are ripe for more consolidation?
The last couple of years, it's all been about new stuff. AI, EVs, battery companies for EV, all that stuff. And in 2021, it was almost it was party time for all that stuff with SPACs and this, that, and the other thing. Many of those SPAC deals are in trouble. I don't know that there are very many that are trading over the $10 they all went public on. Not very many, and many of them are trading under $1.
Yeah.
And they've got money, and they don't have any debt, but they also don't have any revenues, so they're going to have a drop-off point. There was an article in the Journal a couple weeks ago that the vast majority of the EV companies are going to hit the wall, even though some of them have a lot of cash still on their balance sheet, but they have no revenues. So you're going to have a lot of distressed plays, but it's going to be different this time because it's not workouts of debt and stuff. These are trying to piece companies together that can make it, and some will. I mean, there will be EV companies that survive. There just were too many of them for the longest time. So there'll be a lot of distressed stuff. I think what we saw in the last quarter, the fourth quarter, is going to be the hallmark of going forward, with the exception of private equity, which I'll mention in a second, which is traditional businesses. We saw two giant oil deals. Oil deals? Wait, how does that fit in with EVs and stuff like that? Well, they have to fill in their gaps too, and they're no longer willing to make bets in Africa and other places where they can't be certain about what's going to happen. We saw a steel deal. Now, that one may get a little opposition from him, right?
That's going to be a fight.
I know. But we see, so these are big, we'd call them, I guess, unsexy in this world today, but stable businesses with strong cash flows.
Yeah, just real quick, though, and we have to go, Bob, but you mentioned the U.S. Steel. You're referring to the U.S. Steel Nippon deal. I'm curious, in an election year, I mean, if you were advising on this deal, is there any chance that's going to happen, just given the political environment? I'm not saying whether it's a good deal or not, just whether the political environment will allow it.
I think it closes, but it's not going to be. It's going to be drawn out.
Okay.
It'll be sort of like flipping it into the China thing, sort of like that Broadcom V-Ware thing. It's going to take a long time.
Gotcha.
All right, Bob, got to leave it there. Hope to have you back soon. Really enjoyed this conversation. That is Bob Perfusik, Global Chair of M&A at Jones Day. Thanks for joining. And coming up, we're going to get more insight on M&A with Ethan Klingsberg, head of U.S. Corporate and M&A Freshfields. This is The Close on Bloomberg.
All right, let's turn our attention back to Boeing. Those shares lower after the Federal Aviation Administration grounded all of that company's 737 MAX planes until further notice. Our next guest says, and this, of course, has to do with that incident that happened on Friday on an Alaska Airlines flight where part of the fuselage effectively came undone from the plane and it had to make an emergency landing. Now, our next guest says that this was most likely related to a manufacturing issue with this particular aircraft rather than some broader issue with the make and model of these planes themselves. Jason Gursky joining us to talk about this. He's managing director and lead analyst for aerospace and defense over at Citigroup. He's got a buy rating on Boeing as well. All right, Jason, let's get right to it here. I mean, we all saw the footage of it. Scary if you're a passenger. If you're an investor, should you be scared as well?
Look, I don't think so at this point. I mean, the fact pattern here is really pointing to a manufacturing issue or some tinkering of the plane at an MRO facility here potentially. Investors should be thinking to themselves, manufacturing or design? What's the issue going on here? If it's manufacturing, it's probably a near-term concern. We'll get through it. The aircraft will be grounded for some period of time while we go through these safety checks, and the airlines start flying the plane again. Making sure that they don't have this issue. If it's a design issue, then Boeing's got to go back to the drawing board and design a fix. I don't think that that's what's going on here. This plane has been flying safely since the late 1990s, and its current version of it since 2015. Haven't seen any issues like this. This was a brand new plane that came off the production line here in October. So the fact pattern here suggests to me that this is either a manufacturing issue or there was some kind of MRO post work that was done on the aircraft that ended up leading to this issue.
Okay, Jason, so maybe not a huge deal in the grand scheme of things, but talk to us about the reputational risk here, especially for Boeing, which obviously has had some well-publicized issues in the past couple of years. How do you factor that in?
Yeah, look, I mean, it's not great, right? You want them to be have quality under control here. So if this ends up being a manufacturing issue, either at one of their suppliers or at one of their facilities where they were doing the final assembly that caused this door not to be installed correctly, that's not great. I think the bigger worry from a reputation perspective would be if it was a design issue. And again, I think that's a pretty low likelihood. Now, all that being said, airlines do have choices, Airbus or Boeing. But both of these guys have got backlogs that are filled up for years to come. So I think on the margin, it doesn't have a really big impact on production rates ramping, orders here in the midterm. And from a financial perspective, if this really is a manufacturing issue and these aircraft are back up and flying here sometime in the next several weeks, it's going to have a pretty de minimis impact on financials for Boeing.
And this gets us to this idea, though, too. I mean, there's been a lot of focus right now on Spirit Aero, which, of course, makes the fuselages, and whether some of the other issues that they had prior to this incident really start to compound themselves here. I know this isn't directly under your coverage here, but should investors be paying more attention to them?
Oh, investors should absolutely be paying attention to Boeing's supply chain, and Spirit on the 737 is the most important supplier. So investors should absolutely be paying attention to how Spirit is doing. And look, on that front, they did have some issues in the spring with the tail of the 737 fuselage and the aft section, the aft bulkhead section in the summertime. They've swapped out management team there, both at the top, and they're making their way through the ranks. I think the motto there these days seems to be, bite, chew, and swallow, kind of back to basics. And, hopefully we'll see steady improvement, out of Spirit here. I will note that this fuselage looks like it was probably built over the summertime at the peak of all the problems that Spirit was wrestling with. Don't know if there's any correlation here. Like I said, this could be something that happened kind of after factory work that was done on this aircraft. It's still too early to tell, but absolutely investors should be paying attention to what's up at Spirit.
All right, Jason, great to catch up with you. Jason Gursky over at Citi here. A closer look at Boeing and that incident that everybody was enraptured by on Friday. Boeing shares having their worst day right now, going back to late 2022. Spirit Aerosystems at one point was down as much as 16%. A lot more coverage coming up here on The Close. Stick with us. This is Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joins us as he does every day at this time. David, it's Monday.
Yeah.
And I guess we can say this today. It's Merger Monday.
Merger
we don't
Monday
get to say that
exactly
often
right.
anymore, but it looks like we are starting to see a pickup in deal activity.
Maybe it's coming back. Yeah, we had a couple of big mergers announced just today. So we're going to turn now to another expert in mergers and acquisitions. He's Ethan Klingsberg, Freshfield's head of U.S. corporate and M&A. So welcome back, Ethan. Good to talk to you.
Thanks.
So first of all, let's talk about November. When you were last year at the beginning of November, one thing that's changed since then is the stock market. It really took off at the end of the year. It's been last year was a little bit quiet in mergers and acquisitions. Does that make a difference in your business?
Well, one of the interesting aspects of the prices going up is I think the multiples in the U.S. relative to multiples on some of the non-U.S. exchanges are much higher, which creates a nice arbitrage opportunity, which I think maybe we'll see more cross-border M&A. This year was very busy for us on cross-border M&A. So we're seeing companies listed outside the U.S. just migrate to another new listing here and turning it into their primary listing, getting a multiple bump. But we could also just see a lot of U.S. companies spending their cash overseas because those earnings, you could pay a premium, but still you bring those earnings back and they're worth a lot more here. And then I think we may see some companies back into a U.S. listing through stock combinations. So you have you're listed outside the U.S., do a stock for stock combination with someone listed here, get into that S&P 500, and all of a sudden you've got a better multiple. So it could lead into some nice cross-border activity.
Ethan, you may be being a little modest. Are you number one, according to Bloomberg, on the tables actually in cross-border?
Yes.
Yeah, okay, you may as well say that. I'm going to take the credit for it. So one of the things we talked about was actually how you finance these deals, whether they're actually arbitrage on multiples or otherwise. How are you actually financing these days? Because when we last talked, you said it's largely equity.
Right. I mean, look, the secret sauce of an M&A boom has got to be leverage. And so just looking at private equity, we're going to be topped out at deals around $4 billion if all we're doing is these equity backstop deals. So last time I was talking about the private credit markets, I think we've got to get more fluent and better using these private credit, and meaning that what I call the mosaic capital structure has to start being used more. And by that, I mean not just the private equity side, then topping that off with some family office and sovereign wealth money, but then also building out the capital structure with creative instruments that take into account rating agencies, cash flow needs, and a lot of money flowing into this private credit space. We have folks coming in who kind of stayed more toward distressed investment before. Now they're getting into the more refined, genteel M&A space. So we've got to start using that mosaic capital structure more fluently. And if we could get there, then we could start seeing deals over $4 billion in the LBO space.
I'm curious as to why we haven't seen that, at least not en masse. So
right. It's hard.
Yeah.
It's not. Also, there may be a little bit of a fear. These guys are not as friendly necessarily if things go south as your syndicated bank loan lender. Mm-hmm. So if we start to see defaults, that could lead to some more hesitancy. It's also not so easy. It's not as intuitive. It's easier to go to some of the big, guys who syndicate big bank loans like J.P. Morgan, et cetera. Mm-hmm. So there's work there. But I see the investment banks are now referring deals back to their in-house private credit. Mm-hmm. So we could see more. One headwind on that could be there's this Financial Standards Oversight Council and a Stability Oversight Council.
FSOC,
yeah. They've introduced the end of last year some proposed rules to basically treat a lot of these large private credit funds like banks. If that starts to happen, then we could have all sorts of regulatory requirements which would put the brakes on some of that exuberance.
Well, on the topic of regulation, in addition to whatever FSOC actually does come to the table with, we've already seen regulators at least try to get in the way of some of these big deals with varying degrees of success here. Is that regulatory overhang, meaning from an antitrust perspective, is that still an issue?
I think buyers and advisors are feeling really solid right now on antitrust, notwithstanding the headwinds. I think the playbook on how to fight, how to move quickly, how to not agree to timing agreements, how to allocate risk in the agreement through reverse termination fees tied to regulatory issues, not give away too much in the allocation on the buy side. I think those playbooks are all worked out very nicely now. And folks are finding spaces like cybersecurity and renewable energy where there's not so much trouble on the regulatory side. So yes, we don't know about all the deals that aren't happening, but when folks have their eyes on a deal, I think they feel like the playbook and the avenue is there and they know how to fight.
You think we spent a lot of 2023 paying attention to the Fed, watching them raise rates and then anticipating them cutting rates. Right now, the markets seem to think there's going to be cuts. How does that affect your business? How important is it for people considering these deals to think they know where the interest rates are going?
Yeah, I think the more important fact is getting the bigger checks. And I don't know if the syndicated banks are ever going to start writing bigger. They got burnt so badly in 2022. And all last year we were saying, when are they going to start writing larger and larger checks? And there's a lot of hesitancy there. I think you're going to see people come in and they say, well, there's a lot of portfolio companies which have to be flipped. And even if you can't get a great rate on borrowing to buy these private equity portfolio companies, that will happen anyway. But there's so much going on right now in what I call secondary liquidity transactions, where you have these private equity funds owning all these portfolio companies, and they're taking out NAV loans, different types of investments, so that they can return money to their limited partners without selling the portfolio companies. Now, whether limited partners are going to tolerate incurring all that debt, we'll see. But that's a real headwind for doing M&A because you could just borrow at the high level. Ironically, one area where we may see mergers as a result of that is between fund managers, right? Because it's easier to get these loans, these investments in the fund manager if you have a bigger, more robust portfolio. So to optimize your ability to take advantage of that, we may see the fund managers start to combine.
Ethan, it's always a pleasure to have you with us. Thank you for joining us. That's Ethan Klingsberg. He's Freshfield's head of U.S. corporate M&A. There's one other thing we know is going to happen next year. That's an election, presidential election.
Yeah.
And you have to wonder whether people start to think this year. I'm sorry.
Are you still writing 2023?
I'm still. I have to control. I have to control myself. Good catch. But you have to wonder if people are going to think that President Trump, if he were reelected, would be a lot easier on some of those regulatory issues you identified. Whether people might hold back a little bit, say maybe we have an easier time after November.
Well, there's already been some reporting on the Bloomberg terminal saying that some folks are looking ahead to just that maybe they stall for a few months and figure out where the political winds are going to blow in November.
Yeah, it has happened before. Tomorrow, we're going to hear from Maya McGinnis, Committee for a Responsible Federal Budget, about what a Trump presidency might mean to the deficit. Friday, we're going to be joined by Glenn Hubbard of Columbia Business School. That will all come up at 6 p.m. Eastern Time on Friday, Romaine.
And of course, David joins us every day around this time on The Close for our Wall Street Week Daily segment. As we round out into the final hour of trading here on this Monday afternoon, stocks staging a pretty strong rally, recouping a good portion of the losses from last week. This is The Close on Bloomberg. Just about 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostick.
And I'm Katie Greifeld.
Interesting to see some of the price action in the markets today. It is green across the screen. And you go back to last week here, that 1.5% drop on the S&P 500. And today, we're up 1.2%, so basically clawing back almost all of those losses.
A distant memory, and it's really being led by tech. I mean, you take a look at the NASDAQ 100, also off to the races today. It probably helps that you are looking at that bond rally continuing, rates continuing to come down, 2-year yields off by about almost 4 basis points.
Yeah, and interesting moves, too. You pointed this out a little bit earlier in Bitcoin at the bottom of your screen, up 6% on the day, back above 47,000. You're smiling. Why? How much Bitcoin do you own?
Maybe this is the week. I'm smiling because we've been reporting on this for years, it feels like, at this point. Maybe we're finally going to see the SEC approve a spot Bitcoin ETF. It feels like we're very close.
Yeah, of course, that deadline approaching here for a decision. Crude oil down on the day by about 4%. In fact, the worst single-day decline that we've seen for crude in about a month. And I was keeping an eye on some of the shipping rates. We talked about this a little bit earlier, Katie, here about some of the measures that shipping companies are having to take to get around the Red Sea, as well as obviously the issues going on in the Panama Canal. You can see shipping rates have gone up pretty significantly here. Hard to see at the edge of your screen there, but basically we're averaging right around $4,000 if you want to get something from Shanghai to New York. Now, we should point out, normally those rates are between like about $1,500, $2,000-ish. So this is certainly elevated. Now, what you don't see if you pull that chart back to include the pandemic, we forget that those rates went up to like $14,000, $15,000, $16,000 back in 2021 when the pandemic completely blew everything out. So those shipping rates much higher than where they should be, but nowhere near where they were a couple of years ago.
Right. We've seen much worse, and we'll see how that develops in the coming days. But for right now, it's been good news for the shippers, at least when it comes to their stock prices. Let's get to some of the other movers that are moving today. We have to talk about Boeing. Of course, it's really one of the biggest stories today. It's 737 MAX 9 model temporarily grounded by the FAA after that weekend incident. We heard from Jason Gursky of Citi earlier saying that this is a short-term event, but given that the 737 MAX is Boeing's biggest revenue source, you're seeing that reflected in shares today. I also want to talk about holding. This is an interesting one. Of course, the news that Tiger Woods...
This is not the semiconductor company.
No. Okay. This is a shoemaker. So Tiger Woods...
They don't make chips.
They don't, not as far as I know. So the story here is that Tiger Woods is leaving Nike. There was a report that he was signing with On. We actually heard from the co-CEO saying that there's no current plans to partner with Tiger Woods. Apparently, traders didn't hear that because it's still rallying.
Well, okay, first of all, he's left Nike. He's confirmed that, right?
Yes.
We know he's not going to go without some sort of shoe, athletic apparel deal, right? I mean, that would be insane.
Right.
I mean, he's Tiger Woods. He can go anywhere. So the question is simply where?
Apparently, it's not On, but maybe someone thinks it's still perhaps.
Do they wear Hokas on the golf course? Can you?
I don't think.
I mean, they're kind of thick soles. I feel like they get in the way.
There's too much cushion.
All right, we're going to talk a little bit more about where Tiger Woods is heading as we move closer to those closing bells. Our cross-platform coverage. It starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic alongside Katie Greifeld. We're joined right now by our colleagues Carol Masser and Tim Stenovic in the radio studio as we welcome our audiences across all of our Bloomberg platforms here on a Monday afternoon. That is a huge, huge pivot from what we saw last week, where stocks fell about 1.5% on a weekly basis. The S&P clawing back most of that today, up 1.2%.
Yeah, I mean, the chart's really significant in terms of an upward move. We've got support in the retail sector, airlines, semiconductors, a lot of fundamental news out, or at least analyst calls that have really provided some momentum to the trade. So we're looking at, a session that's pretty much at its highs of the days. Speaking of highs, it's not only investors...
I like what you did there. Okay.
I dropped it. Nonetheless, there's a report out in the Wall Street Journal about Elon Musk's alleged drug usage and what Musk is using. They're talking about LSD, cocaine, ecstasy, psychedelic mushrooms. Our own team noting that, this is just another thing that Tesla's board has to deal with. And they've had quite a long list of things that have kept them busy, Tim, over the last few years.
Well, we should note that Elon Musk did not respond directly to the Wall Street Journal's request for comments, but Alex Spiro, a lawyer of his, did respond to some questions posed by the Wall Street Journal. He made the point that Elon Musk is drug tested regularly at SpaceX and has never failed a drug test. But you guys remember back in 2018 when Elon Musk went on Joe Rogan and smoked marijuana.
I will never forget.
There was a big hoopla after that. I think there's a bigger picture here, though, when it comes to the way that we think about drugs as a society and we think about the way that executives use drugs. I think in a case like this, people don't necessarily complain if the companies that the executive is running are doing fine, if the stock is doing fine, if they're on an upward trajectory.
It's hard for me to imagine, though, if someone like a big bank CEO was going on Joe Rogan smoking marijuana, that it would be the same response.
Yeah, Elon Musk is different, though.
I guess so.
Yeah.
And Tesla is different as well. I mean, you think about the shares. So of course, that's one of the most heard stories today for obvious reasons. The other big story we're following, of course, is Boeing and what happened with Alaska Airlines over the weekend, of course. An interesting second day story, if you will, is apparently there was an iPhone that was sucked out of the airplane and it survived its 16,000-foot fall. Apparently it was found still with, pretty good battery life, very little dents and bruises. Apparently, it was on airplane mode, and it's pretty amazing. You can see the shot there. That looks better than I would after falling 16,000 feet.
Is this real or is this a hoax? I'm confused. So it fell 16,000 feet, and it landed. We should point out, they said it wasn't even locked screen. And just a couple bumps and bruises. I mean, I once dropped my iPhone literally like 2 feet while I was getting out of my car, and the entire thing like shattered into 12 million pieces. So I'm a little skeptical.
Hey, it's in a TikTok video. It's gotta be real.
If you can't believe TikTok,
it's gotta be
who
real.
can you believe?
Gotta have heroes.
Same thing. I've dropped it crossing the street. Everything was shattered. It was gone.
Yeah.
Maybe you guys don't have the right cases.
Maybe airplane mode is the secret.
I was thinking...
Or maybe, as Steve Jobs said, we're all holding it wrong or something like that. I don't know.
I was thinking, is this an iPhone ad? Is this an elaborate iPhone ad? Maybe it's an ad for, a case or a screen protector, but it is...
OtterBox is going to finally come up and say,
true.
Gotcha.
It is pretty amazing.
Do you guys use airplane mode?
No.
This is the conversation.
I never use airplane. I always forget to use airplane mode.
Oh, so you're the reason why the fuselage is break out of the plane, right?
Should I not be confessing that? But I always
don't think you should confess that.
Haven't you ever been on a plane and you're just like, let me just turn it off or
plead
turn
the
it
fifth.
back on? Yeah, see, exactly. All right. Anyway, some interesting stories on a day where the risk trade is definitely full on. We're going to be back in less than an hour's time. We're going to count you down to the close on this Monday, our cross-platform radio, TV, YouTube, and of course, Bloomberg Originals. We're going to see you for Beyond the Bell at 4 p.m. Wall Street time.
And we continue our markets coverage right here on Bloomberg Television, counting you down to the closing bells, just about 50 minutes away. And let's take a closer look here at the latest Bloomberg MLive Pulse survey. Here's the question. What are the biggest risks to earnings here in 2024? And the answer? High expectations. Results show that 50% of investors polled think many are in for a reality check this season, and that an economic slowdown is the biggest risk for bottom lines. Let's get some perspective out of our next guest. Carol Schleif joining us right now, Chief Investment Officer over at the BMO family office. Carol, great to see you here in the new year. I'm told I'm not supposed to say this anymore, but Happy New Year to you. It's still, only January 8th. Thank you very much. Let's start off with expectations. I mean, they certainly were elevated, let's say, heading into the end of 2023. Is that elevation enough of a concern here as we look to 2024 and what we should expect out of corporate fundamentals?
I think the expectation, especially as you look at the fixed income markets and assuming a lot more rate cuts and sooner than the Fed is communicating, that expectation does tee it up for a little bit of the volatility, which we saw last week. And we would expect to see some of that continued volatility, but we do think that underlying all of this, you will have reasonable returns in both stocks and bonds for the year, and that things will sort themselves out. The great part is we have a lot of data. We have a lot of news coming out in the next couple of weeks. We have big bank earnings starting on Friday. We've got earnings in general over the next few weeks. We have CPI, PPI, Fed meeting end of the month. So there's plenty for us to hang our hats on, but there's also a lot of potential adjustment period that markets will need to go through in terms of how good they think earnings are going to be, and particularly how soon the Fed starts to cut rates and how often it cuts rates.
I know you're a long-term investor, so you're looking much further down the road than maybe we do sometimes on this show. But I am curious about some of the incremental moves in 2024 and the volatility that we saw, particularly in fixed income last year, volatility that fed to a certain extent into equities. Are we going to see something that maybe is a little bit more steady this year?
We do suspect that you'll level out into that as investors and traders get adjusted to a new level of neutral rate, because the neutral rate's been zero to negative for so long that all of us, even those of us that remember neutral rates that were higher than zero, got used to the fact that money was cheap. Now we have to rethink business plans, rethink the way that lending plans, and everything has to be rewritten with a newer rate. And once that gets adjusted to, which we think you're close, because when you look, take the housing market, for example, when mortgage rates hit 6.5% the first time, things locked up. Then they went to 8%, and then they came back to 6.5%. Now all of a sudden, 6.5% seems a lot better than it did the first time around. So it's that anchoring to a new expectation that we think you'll see more and more of as things level off in here, particularly since the Fed's communicated that for all intents and purposes, they're going to be try to be done raising rates.
And that adjustment potentially to a higher than usual neutral rate, certainly higher than what we've grown accustomed to over the last decade or so. What does that mean for the equity market when it comes to returns? Of course, we're coming off a year in which the S&P 500 returned, what, 24%? Are we heading into another year like that, or should we perhaps lower our expectations here?
You know, it's pretty interesting because actually a more normalized, from a long-term standpoint, having that more normal rate of 2.5% on the neutral rate, where you'd put a little bit of inflation on top of that, that actually is pretty good for business, and it's reasonable for valuations because it allows companies a little bit of pricing power. It allows individuals to have some wage gains year in and year out instead of the 0% sorts of wage gains, or 0 or 1 that went on for so long. So a little bit of inflation in the system is actually healthy and normal. And we do think markets will be able to adjust to that pretty reasonably. And honestly, statistically, when you look back at studies coming off of a year like we had last year, it's not uncommon to have another solid year coming after that. And given what's going on in technology markets, wouldn't it be fun if we could tee up another mid to late 90s kind of market run?
And the Fed would definitely agree with you that, you know, a little bit of inflation in the system isn't a bad thing. Maybe not 9%, but 2% sounds pretty okay. I'm looking through your notes, and this line caught my eye, that it's the health of the consumer that's a wild card for 2024. And of course, we heard from a lot of the retailers today boosting their guidance. Talk to us about how you see the consumer faring this year.
We think as long as the consumer is employed, that the consumer continues to power through on this, because there was the initial bout of what was termed revenge spending coming out of the pandemic. But I think what we've all learned in the last year or so is that it's not just revenge spending, it's spending more thoughtfully, more strategically and in areas that are important. Lots of services, lots of opportunities to take the whole family on trips. It was interesting catching up with everyone last week, and there were a vast array of people that took the whole clan someplace or went on bigger trips to visit, and has plans to continue to do that through the summer. So consumers, as long as they're employed, that helps put a buffer underneath, and hopefully helps them absorb some of the other headwinds that they are facing. But we'll know more as the earnings season progresses.
I am curious as to whether, though, we should worry about some sort of, I guess, split in terms of consumer spending. The idea that we've heard, at least anecdotally, from folks at the lower end of the income spectrum seem to still be struggling with higher prices, or at least the perception of those higher prices, while folks who are more well-off haven't necessarily felt that and, I guess, feel, a little bit more confidence to continue spending.
Yeah, I definitely think that's an issue, that bifurcation, and we've seen iterations of that going on. Hopefully we get some support at the lower end. You had a number of states move to up their minimum wages. You've had a lot more union activity, and it's not just relegated to those unionized companies, but it's spreading to their competitors through that. I think you're also seeing the flip side of it, in that you're seeing consumers and the retailers that sell to those consumers push back against some of that just incessant price increases, in terms of the manufacturers taking it as far as they can, and consumers are pushing back, saying enough's enough. And you're also seeing consumers, especially younger consumers, say, look, I don't need new. I'll go do recycled or vintage or some other aspect of that, and being more thoughtful about the goods they are purchasing and more strategic.
All right, Carol, it's always great to speak with you. Happy New Year. That is Carol Schleif, Chief Investment Officer over at BMO Family Office. Now coming up, Bitcoin continues to rally on anticipation that U.S. regulators will soon approve spot Bitcoin ETFs. We'll have the latest.
And after that successful launch of that Vulcan rocket launch earlier in the early hours here in the U.S., technical problems apparently jeopardizing the robotic lunar lander that was attached to that. Apparently that's now just drifting away in space.
And Tiger Woods and Nike parting ways after a nearly 3-decade partnership. We'll bring you the details on the breakup. All that and more coming up. This is The Close on Bloomberg.
All right, what a difference a couple of days can make. With 42 minutes until we get to the closing bells, a much different market than what we saw last week. The S&P last week dropped 1.5%. The NASDAQ dropped about 3%. But today, now all the indices trying to claw back most of those losses. Most of the big cap tech names, the Magnificent Seven, doing exactly what they're supposed to do, and that's keep this market afloat. If you're looking for weakness out there, it's much more about some of the idiosyncratic stories. That includes a big drop for Boeing. And you're also seeing a lot of the energy names moving lower, as well as oil prices down about 4% here on the day. But home builders getting a pretty strong bid here on optimism here about the rate picture. The Philadelphia Semiconductor Index and consumer discretionary is also getting a strong bid on the idea here that the interest rate environment will be supportive to corporate fundamentals, and that could justify that big run-up in valuations that we saw last year. Some of the individual stories to keep an eye on, though, of course, keep an eye on Boeing, Alaska Air, as well as Spirit Aerosystems. But look at cytogenetics. There's been a lot of activity in the M&A space, particularly when it comes to healthcare. This stock was on a roller coaster ride today. It was deep in the red earlier in the session. And this was largely because there was no chatter about M&A activity for this company, a company that has actually said that it was open to M&A. However, we did get a report out of the Wall Street Journal a little while ago saying that Novartis apparently is kicking the tires on this company. The shares surging here in the session to about 14% higher than where they were at the start. Meanwhile, Bitcoin also getting a bid up about 7% here on the day. Katie Greifeld.
And let's stay there, because Bitcoin breaking through 47,000 for the first time since April 2022. That's as spot Bitcoin ETF hopefuls file their final documents with the SEC ahead of a potential decision this week. Joining us now for more is Bloomberg's Kaylee Lyons. And Kaylee, to say this is a long time coming feels like a little bit of an understatement here.
Yeah, roughly a decade, Katie, is how long it actually took us to really get to this moment, where it does seem, if you listen to Bloomberg Intelligence or most who watch the crypto and ETF industry, that we are on the cusp of the first spot Bitcoin ETF actually being approved. As you said, we got that last wave of revised S1 filings from prospective issuers. Of course, there also are the 19B4 filings from the exchanges, which Bloomberg's very own reporting, Katie included, has indicated the SEC plans to vote on in the coming days. Put those two things together, and theoretically, you could get a wave of approvals. There is the question of how many could be approved at once, but the prevailing thinking seems to be that the SEC is going to want to keep the playing field as level as possible, so we could get many all at once. What's going to be a differentiating factor, though, for these products once approved, and you're looking at some of the figures here on the screen, is the fees. This is going to be competitive, especially if they're all coming out of the gate at the same time. You have at the low end Bitwise, which is at 24 basis points, but not going to have a fee for the first 6 months. And interesting to see Grayscale's GBTC up at 1.5%, and sure, that's down from the current 2%, but still puts them far above a lot of these competitors. I actually had a conversation around fees with Michael Sonnenschein, the Grayscale CEO, just a few months ago. I asked him how he was thinking about it, and he said, look, Grayscale is a Bitcoin specialist, a crypto specialist. We have a decade-long track record of this, and that's a differentiator, and he suggested they would be able to command a premium as a result.
And this gets to the idea, though, as to the demand here. I know there's a lot of anticipation that once these vehicles are approved, it makes it easier for investors. And in theory, that would increase, I guess, the pool of potential people who would be interested in buying. Is there any evidence that we're going to see that?
Well, certainly it's a theory at this point, Romaine. Obviously, crypto is a famously volatile asset class, and having the ETF packaging, it seems, may make it more comfortable for some, like institutional investors, to come in here. But at the end of the day, it is going to be about how much money realistically is there to go around and how it is divided amongst all these products, which is why you're likely to see some pretty heavy marketing. Obviously, some people, some issuers trying to really have that low fee game, maybe waiving fees for a certain period of time or until there's a certain amount of assets drawn in, what have you. But it is going to be a big market share question. Also keeping in mind in terms of the investment thesis here that just because the SEC is approving a spot Bitcoin ETF doesn't mean the regulatory headache around crypto products coming from the SEC is necessarily over. I would just point everyone to, and you can decide whether this is coincidence or related to a potential spot ETF approval or not. But Gary Gensler, the chair of the SEC, was out with a thread on X today talking about how crypto assets are famously volatile, essentially warning anyone thinking about investing in these products that they are risky.
Yeah, it's been fun to watch most of this play out on Twitter. Bloomberg's Kaylee Lyons, thank you so much. You can catch Kaylee tomorrow on Bloomberg Crypto at 1 p.m. Eastern, and then you can catch me for a special edition of ETF IQ this Wednesday at 1 p.m. Eastern as well. Before we get there, though, much more ahead on the close. This is Bloomberg. United Launch Alliance's long-awaited Vulcan rocket launched earlier this morning, ushering in a new era for the longtime Pentagon contractor fighting to expand market share. The rocket deployed a robotic lunar lander, which ran into technical glitches after blasting off from Florida's Cape Canaveral. And Romaine, I don't know a lot about this story, but I get the feeling that you know quite a bit.
Well, I mean, of course, Katie, I was up at 2:18 this morning following the launch of this. This is a big deal, though, because remember, this is the whole idea to kind of put us back on the moon here. I guess they said something that it didn't face the sun properly when it detached, and I guess that was part. So now basically it has no power, so it's just drifting around out there. But remember, I mean, there's only been a few opportunities to do this. And remember, India did it last year. There have been other countries like Israel that have attempted to do this and failed. It's actually a lot harder than it looks. I mean, you would think landing on the moon would be, a little simple, but apparently it's not simple.
I always thought rocket science was kind of easy, so this is surprising.
I think it's easier if you have someone actually piloting the actual craft. But when you try to do this remotely, it's a much trickier thing, and obviously it didn't work out. But guess what? We're going to get another rocket launch because they're going to try it again. This is the countdown to the close. Just about 30 minutes to go until we get to the end of the trading day. A much different day than what we saw last week.
Oh, yeah. We have a rally on our hands, and it's pretty big and broad. If you take a look at the S&P 500 at the sector level, you can see up top, we do have big tech, that sector up about 2.5%. Of course, NVIDIA being up about 5%. Will do that. But you go down the list, consumer discretionary, communication services also getting in on the action. Really, the only laggard here is is energy. That sector off by about 1.4% as crude continues to slide, Romaine.
Let's take a look at some of the individual movers out there here on the day. Two interesting ones here. First of all, Schlumberger and the rest of the oil and gas service companies moving lower on the day. This on the back, of course, of that big drop that we saw in WTI crude, down about 4% on the day. Similar moves on Brent. Keep an eye on this space as the oscillations that have been going on there now appear to be coming to fruition with confirmation about that drop in demand as Saudi Arabia now cutting their price, their premium price, by about $1.50 here on physical sales here. Twilio shares actually rallying this after Jeff Lawson, the CEO, effectively being pushed out by activist investors, not just the CEO, but co-founder of the company. Investors actually like that. They think that a new change of leadership could actually take this company to a new level. And keep an eye on a lot of the apparel makers. Several of them came out ahead of the big ICR conference that takes place this week to give their outlook for 2024. That outlook was pretty strong. Lululemon, Abercrombie & Fitch, American Eagle, and Crocs all raising their sales guidance for the year. Crocs was probably the most aggressive here. Those shares right now at 104.05, up 20% on the day, Katie. That's a record high.
Let's go from the public markets into the private markets because 2023 was a big year for the growth of private credit. So what's ahead in 2024? Joining us now to help answer that question, I'm pleased to say we have Ken Kencel. He is the president and CEO of Churchill Asset Management, which is a private capital affiliate of Nuveen. Ken, it's great to have you on set with us. And you were saying in the break that the fourth quarter was a record for Churchill. And I guess my question to you is that M&A picking up, or is that more Churchill taking share from traditional lenders?
That's a great question, Katie. Thanks for having me. I think it's both. You know, we certainly have seen our share of the private credit market increase as a firm. So obviously a great year for us. We actually are in the midst of yet very much another record year for our business. But I would say that overall, the stability or the increasing likelihood of stability, even higher for longer, but stability is playing out in a very positive way for the market. So we're seeing deal flow increase really after Labor Day. It's the third quarter, fourth quarter, and going into 2024, I think we're going to see more of that going forward, given the stability we're seeing in and around rates.
And it's been interesting to watch this boom in private credit. Plenty of people calling it the golden age for private credit. I've definitely seen that on Twitter, for example. But it's interesting to juxtapose that with the idea that you really have seen M&A fall off. Maybe, you know, it did pick up in the latter quarter of the year, but you think about global M&A volume falling below $3 trillion. With that in mind, what is fueling this growth? To get to the second part of my first question there, I mean, is this really, some of these companies turning away from the banks?
I think there is clearly a trend looking toward private credit as a solution, right? I mean, if you think about the benefits, right? Speed, certainty of execution, scale, to go to a single private credit manager to deliver a solution. I think that is all translating into private credit taking market share relative to the liquid markets. Now, it doesn't hurt the fact that the liquid markets have generally been closed or much slower in terms of liquid credit. So I think the combination of the liquid markets being slower and private credit raising capital at scale has made private credit an accepted and very much embraced alternative to the liquid markets, and it's benefiting us for sure.
Yeah, not just accepted, but for some people, it's actually become somewhat essential almost.
Correct.
When we talk about that. And I am curious about deal activity, mergers and acquisition activity, and the role that private credit has really played in that. I mean, she talked about that drop in deal volume, but we know a lot of those deals last year wouldn't have gotten done without the help of private.
Without private credit, exactly.
So talk to us about the potential growth of that, or rather, let me rephrase that, the evolution of that as we get into 2024 and beyond. What does that look like?
Well, you know, it's interesting. If you went back 5 years ago, the largest private credit managers could hold maybe $100 million, $200 million. Today, you're seeing, obviously, private credit managers do $1 billion, $2 billion, $3 billion. So it's the scale of capital that's been raised and how that capital gets, offered as a solution to companies looking for financing. So, I mean, even if you go back to the GFC and you think about the lack of private credit, 15 years ago to today, where private credit is now 3 to 4 times the liquid market. So I think as you look forward into 2024, stability will beget increased deal activity gradually, but I think the markets will come back in terms of M&A activity. And I think that private credit has a permanent place at the table. And I don't think it's to the exclusion of the banks. I think private credit managers and banks will work together to deliver those solutions. And sometimes the solution may be a liquid, alternative. Right. Occasionally, even a combination of the banks and private credit managers, and I think that will become the norm. Private credit, I think, has a permanent seat at the table. So I would argue in 2024, what we're really moving toward maybe from the golden age of private credit to the Goldilocks moment of private credit, where rates are still higher, right? Still offering attractive returns to investors and generally lower leverage and better terms, but in an environment maybe where the edge is off a bit in terms of the burden on companies to be able to handle those rates. So I think 24 is going to be a good year.
I am curious, and I think every time I've interviewed, I've asked you about the potential for regulation for the private capital industry. A little bit earlier, we were speaking with Ethan Klingsberg over at Freshfields, and he raised some issues about an FSOC proposal that could actually sort of provide a little bit more of a regulatory umbrella for private capital. Is that something, A, that's on your radar? And if so, how much of a worry is it?
Sure. Well, the new funds rules have been enacted, and we're certainly very much in favor of transparency, right? And I think if you look at the large-scale private credit managers, well, we are providing that transparency. We manage registered vehicles. Those vehicles are registered by the SEC. We provide transparency with respect to all the loans and all the investments we make. And obviously, with our large institutional investors, we do that too. So I think more transparency is a good thing. Yeah. And we're certainly supportive of that.
But does it bother you, though, about the perception, particularly you go back a year ago? And I know it bothers you. This is sort of a loaded question, but you know what I'm getting at here. There was this idea that the private credit industry was so opaque, and that there had to be just this baked-in risk there, that systemic risk that we just couldn't see, and that at some point in 2023 it was going to blow up in our faces. And of course, we know kind of how that ended. It never really happened.
It didn't happen.
And in fact, the opposite here. Does that bother you?
No, and look, I think if you think about the fundamentals of what we do and how we do it, our typical credit is we are investing on behalf of hundreds of institutional investors globally. So as opposed to a single bank balance sheet, we're diversifying that risk across thousands of institutional investors across the world who want access to U.S. mid-market companies through private credit and the terms that private credit offers. So I think in that sense, diversifying that risk and the fundamental nature of how we invest, which is as a long-term holder of the asset, is in many respects driving an approach that is more fundamental in nature. So I think in that sense, we compete for capital based on performance. We deliver that capital in a very transparent format. So I think in that sense, private credit is in many ways more transparent and in many ways more fundamental to the investment process.
Well, Ken, just quickly, that's where I wanted to go, that competition, because as you said, you're investing on behalf of investors who want access to those small and those mid-sized companies. But you think about the public markets, the public debt markets, I mean, yields there are hovering around the highest levels they've been in quite a while. What does that competition look like? Why go private versus public?
So typical company looking for 300, 500 million, 700, 800 million in financing. That company, what are they looking for? They're looking for certainty of execution, to know that if they deal with a manager, a lender, that they're going to get certainty of execution. They want confidentiality. They want to know that if they have a solution, that it's going to be there to provide financing, for example, for an acquisition. So I think in every respect, private capital is a very reliable, very more. You're right, absolutely right when you said earlier, more than accepted. It's part of the landscape. So I think private credit managers offer a very attractive alternative to companies, and I think given the scale that we've developed, I think we're definitely going to be a fabric of the M&A environment going forward. I'd also say though that if you look at the largest private credit managers, we are raising capital from institutional investors because of our performance, because of our track record. So in that sense, that acts as a distinguishing characteristic relative to maybe some of the newer entrants and smaller performers who can't provide the 500 million, the $1 billion solution. In that sense, I think it provides very good value for our investors.
All right, Ken, always great to talk to you. Great insights as always out of Ken Kinsell, President and CEO of Churchill Asset management. Before we go to break, some breaking news here. Shares of Boeing, shares of Spirit Aero hitting session lows just a while ago after a report that now United Airlines is saying that it did find loose bolts and other parts on the Boeing 737 MAX 9 in its fleets here. That's a report coming out of Air Current citing 3 unidentified people familiar with the finding. Those bolts and other parts have been found on at least 5 aircraft, according to those people. We have reached out to United and Boeing for comment on this situation, a developing situation we continue to monitor. We'll be back in a moment. This is Bloomberg.
All right, time now for the top 3. Every day at this time, we do a deep dive into the people at the center of today's top stories, rather. Joining us now is Scarlett Fu. Scarlett, who are you watching?
I'm watching Jeff Curry. He's the former Goldman Sachs head of commodities research, and he's talking about commodities, his old stomping ground. He remains bullish on commodities this year because of rising demand, record demand, in fact, low inventories, and spare production capacity that he says is exhausted. And when asked to pick his favorite commodity, it's copper. He says it has the greatest room for gains.
How do you choose, between all the commodities? What's your favorite?
My favorite, lithium.
Lithium.
Yeah, how about that? All right, I'm keeping an eye on Dave Calhoun, the CEO over at Boeing, who, for obvious reasons, is really on the hot seat right now with that incident that we all saw footage of, that Alaska Airlines flight, that part of the fuselage just coming undone. I mean, NTSB basically saying it's a miracle no one got killed. He had to cancel an executive retreat that was supposed to begin. We're now learning that he has scheduled a briefing for tomorrow, January 9th, so tomorrow, to update investors and everyone else here on what's going on. The latest news that we just got a second ago here was United Airlines now finding loose bolts on its planes as well.
And we'll continue to keep an eye on that developing story. But in 10 seconds, let's quickly talk about Tiger Woods. Of course, he is leaving Nike. This is a 27-year-long partnership. He didn't have a lifetime deal, which I found kind of surprising, but an end of an era.
Where does he go next? That's a question.
I don't know.
All right, we're counting you down to the closing bell. Stick with us. We'll be back in a moment. This is Bloomberg. This is the countdown to the close. Romaine Bostick here alongside Scarlett Fu, counting you down to the closing bells, which are just about 10 minutes away here, and a big difference from what we saw last week, Scarlett, here with that big sell-off here. Most of those losses being clawed back today, with the S&P up about 1.3% and the NASDAQ up 2%.
Yeah, biggest gain of the year so far. I mean, the year's pretty short, but still notable nonetheless. Not a lot of catalysts, though, driving the markets. Obviously, there's individual company stories like Boeing, which we're monitoring carefully, but no big market-moving economic data until CPI, PPI later on this week. But you do have the Magnificent Seven rebounding quite a bit, up 2.6% as a group. And of course, Romaine, we are keeping an eye on Bitcoin. It did climb to $47,000 for the first time since April 2022.
Yeah, obviously a lot of people are looking ahead to what could potentially be an approval of that spot Bitcoin ETF here. Whether they get it or not remains to be seen here. But keep an eye on, of course, what's going on in the commodity space as well. A big downdraft in oil on the day. WTI down 4%. Joining us right now is Lawyer Heinel, State Street Global Advisors Global CIO, to help us count down to those closing bells. And Lawyer, there's been a lot of talk here, I guess, about this idea that maybe the Fed will sort of be out of the way, that we won't be obsessing as much about Jay Powell and interest rates in 2024 the way we did over the last year and a half. Do you think that's going to be the case?
Well, actually, I think we're going to continue to obsess about Jay Powell and the Fed, but it's more about when will they, i.e., when will they make the first rate cut? So clearly, they've pivoted from hiking to cutting, but given the backdrop on the data and given their perhaps reluctance to appear to be moving too quickly, we might have to wait a little longer than we had hoped for that first cut to come.
There was so much focus last year on the returns that you can get in the fixed income space in a way that we probably really hadn't seen in at least a decade, and really probably more than that. For some of us, it might have even been a lifetime, depending on how old you are. But I am curious as to whether that trade, or the attractiveness of that trade, I should say, will still be there in 2024, or are we going to start to see a meaningful shift back into other pockets of the cross-asset market?
So we still have as a core call that rates may be one of the best trades for 2024. Certainly with treasuries backing up just a little bit from the lows that they printed late last year, hitting closer to that 4 handle, you're getting really compensated well to hold 10-year treasuries. And we think that if we've achieved that soft landing, which is something we do believe, you could actually see rates come down a bit from here. And they're actually a great hedge against a harder landing. And we still think that the odds of a hard landing in 2024 or 2025 might be as high as 25%. So there might be more room to run still. So we still like rates here.
You still like rates, but when it comes to the bigger macro picture, you point out that there's still stubborn pockets of inflation. And I point to JP Morgan's Marko Kolanovic, who also has said that he sees geopolitical risks rising, specifically increased shipping costs being something that's going to really challenge this disinflation narrative that everyone's so convinced of. How are you thinking through that risk?
Yeah, I think the first thing I would say is that we do believe that disinflationary impulses are intact, and you're going to see those start to move through from goods into services, and you're going to start to see some of the core numbers come down, not just the headline numbers. So we think that disinflation story is very much intact. But as you note, there will still be pockets of pressure. And so one of the things that we're keeping a really close eye on is which industries, which companies, which geographies are going to have persistent threats of inflation, and how does that flow through to equity earnings? So one of our other big themes for 2024 is to be selective on equities. Look for those pockets where companies have more resiliency, where they're less susceptible to inflationary pressures, and where they don't have refinancing risk, especially as rates still persist to be relatively high.
And Lori, we mentioned earlier about Bitcoin reaching $47,000. With this possibility of a spot Bitcoin or many spot Bitcoin ETFs being approved as early as this week, what kind of demand do you see for people to switch out of maybe some of the more traditional asset classes? Gold might be an obvious one for to make some room for something like Bitcoin.
Well, certainly investors will continue to look for opportunities. And so the way we think about it is, where are there opportunities for diversification? Where are there sort of time-tested trades that one can do? And we actually think that a little bit of gold in the portfolio, for example, is not a bad idea. We actually have a tactical position in gold, in part because it does hedge against those inflationary and those deflationary impulses, and it's got a long track record of being a diversifier against stocks and bonds. So we look at gold as a potential trade versus Bitcoin at this stage.
When we go, I do want to broaden this out a little bit here and look overseas, because there's been a lot of discussion here about the competition for assets between the U.S. as well as other developed markets, and more importantly, with some of the bigger emerging markets like China here. Is there a case to be made for non-U.S. assets right now?
Well, we like to think so, and there certainly are places that we're watching. We think Japan could be pretty interesting in 2024, but on balance, if you believe, which we do, that the global economy is going to slow, then you need to look for those places where there's a little bit more resiliency. And we actually think that U.S. large caps continue to provide the better opportunities. Certainly technology will be a theme in the U.S. You have things like the Inflation Reduction Act and the CHIPS Act, which will continue to buoy demand. So we're still in the place where we think U.S. exceptionalism, for lack of a better term, will dominate. So we're still positioned overweight U.S. versus other parts of the world.
This gets to this idea, though, too, when we talk about the interconnectedness of the global economy and whether those connections are as strong as they were, maybe say, versus where we were pre-pandemic here. How much do we need to worry about those correlations, that if China or another major economy catches a cold, so to speak, do we need to worry here in the U.S.?
Well, we always do. The U.S. is still, though, the largest engine of growth. And certainly if we look at the backdrop for the global economy, we see it slowing pretty markedly. So we're going to be below trend growth in 2024 around the world, probably with a 2 handle. So that will feel quite recessionary in a lot of parts of the world. But here in the U.S., given the current environment, as I mentioned before, some of the tailwinds to growth that we still have, the fact that the consumer's getting a little tired, but they certainly haven't run out of steam, labor markets remain strong, and we actually think the Fed will be back in play in terms of rate easing, not hiking. All of those things we think make the U.S. a better position from an equity standpoint.
And Lori, final question to you. With just 3 minutes to go before the close, I'm looking at indexes at their session highs, but you have the NASDAQ and the Russell 2000 outperforming the S&P 500. Which looks better to you at this point of the year, small caps or more of the Magnificent Seven?
Well, I would say, how about neither of those and look at a broader based large cap exposure? We think small caps are a little bit more vulnerable to some of the inflationary pressures that remain, as well as the slowing growth that we're likely to see. And we think the Magnificent Seven is probably a little bit of a price. So we would like large caps, but more broadening out of the market.
All right, Lori, always great to talk to you. Lori Heinel over at State Street Global Advisors, helping us count down to those closing bells, which are just about 2.5 minutes away. Stocks off the session highs, but still holding on to relatively strong gains, with the S&P up more than 1% on the day, the NASDAQ up more than 2%. And yes, those small cap and cyclical stocks also getting the bid, with the Russell 2000 up 1.8% and S&P 400 mid caps up 1.2%. Our full market coverage, counting you down to those closing bells and beyond, starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with our friends Carol Massar and Tim Airplane Mode Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, originals, and those folks still streaming on YouTube.
You know, every time we fly, Tim will be like, you know what plane we're going on? And, you know, like, he'll give me like the whole, he just so knows. Interesting day.
So no MAX 9 planes for you?
I don't think I've ever been on a MAX 9, actually.
Well, they're relatively new.
Yeah. I've been on a MAX 8.
Oh, okay.
But never on a MAX 9.
Yeah. It's
you guys know the model of the plane that you go on?
Yeah,
oh, totally.
We always check.
Every time if we're flying together for work, Tim will be like, you know, it's this kind of plane. And
I don't think I've ever paid attention to it.
It's like, maybe we should take this trip because we'll get to like have access to this plane and kind of check it out. We got a rally underway, right?
Wait, is that how you plan your trips?
Sometimes. Well, we consider it kind of research,
you know, it's weird.
Right?
We don't have any other trips planned. I don't know if this is, they're not sending us anywhere in the near future. I don't know why.
Maybe it's because of our strategy.
Because all those private jets you keep.
Exactly.
Rally underway, guys. But look at, I was looking at some outperformance in the semi area. You've got NVIDIA and AMD both coming out with some chips for PCs, AI types of chips, so maybe some enthusiasm continuing.
Did you see that NVIDIA story about this? Like they're making the argument that these AI chips need to be on your PC.
Yeah.
Because you have better functionality with the AI thing, which just, I don't know, it seemed like just a way for them to spin.
Sell more chips.
Buy more. Right.
Yeah.
So, okay, interesting.
But it might be a case of you get that chip and then I'm going to be like, well, I want that chip on my PC.
It's interesting seeing this exuberance that we're seeing today, given what we saw last week. And it was certainly nothing, even after the jobs numbers came out, that pushed investors to say, okay, now it's time to buy. What changed over the weekend?
Yeah, I'm not sure anything
2 days
changed.
off.
I mean, we know that, of course, some of the losses that we saw last week had a lot more to do with the start of the year and some of the tax consequences for folks who didn't want to sell in 2023, not necessarily in 2024. So that could be part of the explanation here. Nevertheless, don't look a gift horse in the mouth, Tim Stenovic. Green across the screen with the Dow up 0.6%, the S&P up 1.4%, the NASDAQ up 2.2%, and the Russell 2000 closing out the day with a gain of about 1.9%.
All right, so let's get to it, guys. If you look at the S&P 500, just digging a little bit deeper, 419 names in the index actually finished the day with gains, 82 to the downside, Scarlett, and just 2 unchanged. So yeah, risk on trade in a big way.
Yeah, very lopsided trade when you look at the sector performances as well. You mentioned NVIDIA clearly leading, semiconductor stocks up by more than 4%. Tech hardware also up by 2.3%, and the retailers gaining more than 2%. Only 3 sectors finished in the red: energy stocks, telecoms, and banks. And we should note that telecom remains the best performers of the year. They're still up, and banks are up about 1% on the year as well as they get ready to report earnings on Friday.
All right, guys, so let's get to some of the individual gainers. I had so much to choose from. You mentioned chips.
Embarrassment of riches.
I was like, where do I go? Where do I go? Advanced micro devices. So I mentioned the semiconductor area. AMD, it was a top gainer in the S&P 500, among the top gainers in the S&P 500 and the NASDAQ 100. Up, guys, 5.5% here. Melius Research raised its recommendation on AMD to buy from hold. They've got a price target of 188, stock closing at 146 and change today. As for the news, they said basically, we talked about this, right? AMD introducing new desktop processors, which brings dedicated AI neural processing units to desktop PCs for the first time. This is what we were just talking about, some of the fundamental news out on that. But NVIDIA doing the same things. This was a top performer. Marvell Technology also rallying. So really that whole space on fire. Airlines, we had the Boeing news, right? Boeing obviously down in today's trade. you guys have been talking about. We have too, on concerns about that 737 MAX 9 plane. Having said that, American was a top gainer in the S&P 500, the number one gainer. Morgan Stanley upgraded it to overweight from equal weight. The analysts there saying that the company is continuing to make progress with its balance sheet and that its execution post-pandemic has been strong. Analysts also saying largely that this is going to be one of the most consequential years for airline history. So talking about some of the conditions that are out there, I guess, for people to be out there flying.
Just an update on that, too, because we've been talking a lot about how this affects Boeing, but we also point out the airlines have made it clear, too, that the grounding of some of these planes is going to have ramifications for those folks traveling. Alaska Air intimated at that, and now we're getting a report, Carol, from Reuters that United says to expect significant cancellations on Tuesday.
Well, we did see, too, right, UAL or United coming out earlier about specifically seeing some concerns, too, with their 737 MAX 9. So this is kind of some of the headlines. You're right. Julie Johnson talking to us about that. Like, what does it mean for the airlines, the carriers specifically, and what kind of problems that they will see? Hey, one more, guys. We did see the retail group, Lululemon, Athletica, Abercrombie & Fitch, American Eagle Outfitters raising their sales outlooks today on the back of a strong holiday quarter. I'm just going to mention Abercrombie & Fitch. It is up, what is it, about 6.3%. It had a gain of 285% last year. I know. I continue to do it because it's like a sleeper stock.
You know, we call it a teen retailer for, as a shorthand, but it's no longer. Have you guys gone into an Abercrombie & Fitch recently?
Not in decades.
They sell a lot of workwear clothing.
Like a jacket or something?
Jacket, pants, bodysuits. And very neutral colors, everything.
Do they sell Crocs?
They don't sell Crocs.
Did you see this? Crocs, more than 12 times its 20-day average, really a lot of volume. They expect record 2023 revenue, 2023 revenue? Is that right? Fiscal? Maybe that's their fiscal year. After a successful holiday season, and the stock was up.
They're talking about 2023, Carol, the fourth quarter. We haven't gotten those numbers yet.
I know. I was just jumping ahead.
I know it's a little.
This is what happens when you get 4 gainers, Carol. You got to,
There
was so much. You have no idea. Look, I have 2 sheets today. I only
way
have
too
20
much.
Anyway. You guys, man.
You get too many. You get too many
You're
gainers
harder
on a
than
day
my
like today.
Ford brothers on me.
Okay,
man.
I got to start with Boeing, the worst performer in the S&P 500, and on a points basis and on a percentage basis. Shares falling on the day more than 8%, falling in more than a year. We all know the news: the 737 MAX 9 model temporarily grounded by authorities following that incident on January 5th. We spoke to Julie Johnson a little earlier in the program. She did say there's a chance that if they resolve this, then the planes could be back in the skies very soon. Though, Romaine, you did just mention the news about United canceling flights tomorrow. We should note also the Air Current reporting just in the last hour that United Airlines found loose bolts and other parts on the Boeing 737 MAX 9 plug doors during inspection. That news actually sent shares lower late in the day. Let's also talk about Maersk and talk shipping a little bit. These are ADRs of Maersk that are traded here in the U.S., falling about 5% on the day. Container company stocks were hit by a report in a Danish publication, Shipping Watch, that said that meetings between Houthi rebels and ship owners had taken place. We should know that Maersk denied any pact with Houthi rebels to facilitate the safe movement of vessels through the Red Sea. Still shares following 4.8% on that news.
And we should point out there was at least one company that did confirm, right? It was Costco, the big China, not Costco, but Costco, the big China company. They said they're not going to they didn't confirm that they reached a deal with the Houthi rebels, but they said they're not going to go deliver to Israel anymore. So that would seem to suggest that maybe they did strike a deal.
Isn't it notable to see the companies fall on potential news like this because shipping rates would come down?
Yeah.
So ostensibly it would be good for a shipping company. It's just, it's a wacky world that we live in.
Yeah.
Speaking of a wacky world, here's a small cap to talk about. This is Solo Brands, ticker DTC.
Oh, I'm glad you brought this up. Yeah.
It's a $326 million market cap. Yeah, they make the smokeless stoves.
Yeah, no, I know what they are, but why were the shares down 30%?
Worst day ever. Okay, the company came out and said that it cut its full year forecast and also named a new CEO. You had one analyst call it, quote, highly disappointing, which I think is an understatement if you own this stock. And Piper Sandler downgraded Solo Brands to neutral from overweight.
Yeah.
They advertise a lot on Facebook and Instagram.
Should I get one?
Well, I don't know.
I would wait for a price cut.
Those might be
Wait for a
in the near
price cut.
future, unfortunately.
Odd lots, right? Like to come,
Yeah.
maybe.
Let's take a quick look at yields before we move on here. Not actually much to look at here. Yields across the board did move lower here on the day. In fact, the entire curve shifting lower, of course, after last week, all shifting higher back above that 4% mark. 4.36 right now on a 2-year yield. Your 10 still camped out right around 4. Meanwhile, your 5-year dipping back below that 4% level here on the day. But this doesn't really seem, I mean, when we talk about the market moves, seem to be as driven as much by the macro as maybe it was towards the end of last year. This really does seem to be a lot of folks just kind of wholesale coming back in, looking for, I guess, what could be considered value, and I guess to a certain extent they found it today.
Yeah, it feels like we're in a waiting game right now. We're waiting for a bunch of different catalysts. We're waiting for earnings season to start on Friday. We're waiting for CPI and PPI on Thursday and Friday. We're also waiting for the SEC to potentially approve all those spot Bitcoin ETF applications. So there's just a lot of people waiting to see how things shake out.
I also thought it was interesting that there was a fair amount of M&A activity once again in this market. And I feel like, companies aren't going to do it unless they feel pretty upbeat about the outlook. So maybe we'll start to see that play out when we start to get the earnings, starting with the big banks, but everybody else. We'll see what kind of visibility or comfort they have about where we are.
What do you guys think is the biggest catalyst of the week? I mean, I think CPI on Thursday is huge, but I think that could sort of get blown out of the water, Romaine, if we start to hear something surprising from the banks on Friday.
Yeah, potentially. I'm also look too. I mean, keep in mind we're kind of entering into that conference season. You were talking about Crocs and Abercrombie. I mean, they have the big ICR conference, so they have to get those forecasts out there. We have, while you were speaking a little bit earlier, Urban Outfitters updated its forecast, a 10% year-over-year growth here. So I think, and when we have that JP Morgan Healthcare conference, so we could start to see a lot more forward-looking guidance coming out of these companies, as they, of course, have a regulatory requirement to disclose this stuff before they go into those conferences and start running their lips.
Yeah, it just felt like some positive sentiment, barring what's going on with Boeing. Obviously, that's a specific story, but it does feel. I don't know. It's early. What?
The Boeing thing is just, and then I mean, in all eyes really have to go back to Spirit Aerosystems.
Yeah.
I mean, you talk about the past problems. I mean, something's clearly going on over there. And I know we've had Lee Klaskow and a couple people on, or not Lee Klaskow, I'm sorry, a couple other analysts coming on and basically saying that this is clearly more about a manufacturing issue rather than design, which means it would either fall on the airlines or on Spirit in terms of responsibility.
Yeah, but people see the name Boeing. And, they certainly associate it with Boeing.
Well, did you see the comments out of the, who was the airline executive, Tim Clark, who was speaking a little bit earlier with us, Bloomberg, basically kind of eviscerated them, just saying that there's been quality control issues, in his view, for quite some time.
Well, we know it, right? They went through a period of cost cutting and making some changes. But anyway, more certainly to come, guys. All right, that's a wrap on this Monday. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals.
Does Carol ever let Tim talk on his outros?
Yeah.
Does Romaine let anybody talk? See you tomorrow.
That's a scene right now.
Bye-bye.
All right, stick with us. A lot more coverage coming up here on Bloomberg Television, including the drumbeat to a potential spot Bitcoin ETF. A lot of optimism out there. The U.S. regulators will finally provide that approval. We're going to discuss that coming up in just a bit, right here on The Close on Bloomberg. If last week here in the U.S. was all about a sell-off, maybe the start of this week is all about, well, buying into that dip. We saw that big time today with the S&P 500 up about 1.4%, clawing back almost all of the 1.5% loss from last week. Similar moves to the NASDAQ 100 up about 2%. Remember, it dropped 3% last week. The Philadelphia Semiconductor Index also getting a strong big, as did the Russell 2000. Meanwhile, we've been talking a lot about some of the individual stories. Spirit Aero, one of the big decliners on the day, down about 11% here on the back of concerns here about what's going on with the fuselage on that Boeing MAX 9 jet, I should say. Meanwhile, a lot of the apparel makers and retailers are starting to come out with their forecasts for the 2023 and more importantly for the year ahead, I should say. And they're really talking a lot about this idea of a continuing strength in consumer spending. We heard that out of Lululemon. We heard that out of American Eagle as well as Abercrombie & Finch. We also heard that out of a few other names, including Crocs. Those are some of the biggest gainers here on the day. day. Bitcoin getting the big move here on the day as well, trading around that 47,000 level. We're going to get to that discussion in just a second. But I do want to go back quickly to the physical commodities market here. There's been a lot of talk about what's been going on behind the scenes when it comes to demand for crude oil. A little bit earlier, there was a story on the Bloomberg terminal saying that physical sales of oil coming out of Saudi Arabia have now been dropped by about $1.50 on the top of that premium that they would normally get here. That's raising a lot of concerns that the demand situation is a lot worse than maybe what OPEC Plus had been telegraphing here. You now see Brent crude now testing to the downside, one of their key moving averages. Scarlett.
All right, and looking ahead, of course, in the ETF world, people have been talking about only one thing of late.
Spot Bitcoin ETF.
Bitcoin ETF.
We have, I think, somewhere between 8 and a dozen filings in front of this agency with regard to exchange-traded products around Bitcoin.
If all goes as we believe it should be going, we'll have a number of issuers come out of the gates at the same time. So you will have a number of options for investors.
I think in January, the approval of the spot ETFs is going to be a major catalyst that's going to definitely drive a demand shock.
The arrival of GBTC as a uplisted spot Bitcoin ETF, as well as spot Bitcoin ETFs more generally, is actually the beginning of an opportunity for the advised wealth market in the United States.
It would be the approval and the launch of the spot Bitcoin ETF. For more, we're joined now by James Seyffert. He is Bloomberg Intelligence ETF analyst. And James, it's T-2 right now, with the deadline to approve or reject the ETF applications being January 10th. Given that we got a slew of filings this morning, what did we learn in terms of what are the final steps that need to be taken before SEC approval is forthcoming?
So this morning, we didn't learn too much about the steps. We kind of knew the steps this morning. So 19B4s, which are these rule change documents, essentially, that's the deadline for January 10th. That needs to happen. The SEC needs to issue a rule change and basically grant those approvals if they do, as we expect and as most people are expecting based on that clip you just played. They also need to, those documents we saw this morning were S1s or prospectus documents. And basically what we learned from this morning was these guys are going with really low fees. I mean, these fees are exceptionally low. There's a lot of people waiving fees to literally 0%. But those S1s also need sign-off from a different division of the SEC. So once we have the sign-off on those S1 documents and we have the sign-off on the 19B4s, these things could begin trading the next day. And right now, it looks like the SEC is gearing things up to let these Bitcoin ETFs begin trading on Thursday.
Okay, and of course, the thinking being that the SEC would approve of a group of Bitcoin ETFs at the same time, so that it doesn't end up playing favorites in any way, the way it did with the Bitcoin futures ETF. To what extent is Gary Gensler, the chair of the SEC, set to approve these products with extreme reluctance, given that they had to be pushed into it through a lawsuit?
Yeah, I mean, as far as I'm concerned, Gary and the SEC have somewhat been backed into a corner here by the Grayscale lawsuit and by moves from these issuers, BlackRock getting involved. A lot of these issuers have been chipping away at the SEC's concerns for the better part of a decade to get these things approved. So now we're looking, there's been 14 filings. We're looking at about 11 ETFs that we think could launch on January 11th, which is rather ironic now that I think about it for the first time. But we think Gary has basically been forced to approve these things. And for a political nature, he's a politician. The people that he's aligned himself with, namely Elizabeth Warren, are very anti-crypto. So he's very much doing this against the best wishes or what he would like to do. But the courts have kind of, he said in that quote that in one quote that the courts dictate what authority he actually has, and he's going to listen to the courts here. Yeah. So that's why we think that the approvals are coming.
Well, the courts certainly dictate that, and if they do get these approvals here, I think the market's going to dictate whether that was actually a wise decision. And I am curious when I hear 11 ETFs potentially being filed, and obviously what could potentially be quite a few others down the road here. Is there enough demand, appetite for that right now?
Yeah, I mean, we're hearing about significant capital waiting in the wings here to invest in these Bitcoin ETFs. Now, how much of that is net new capital to Bitcoin or basically transferring it from some other different Bitcoin exposure to new exposure? That's unknown. The thing is, with the ETF markets, it tends to be a winner-take-most situation. It's not winner-take-all. It's not like one ETF is the one that covers this area and then no others. I mean, we have 4 specifically S&P 500 ETFs with billions of dollars in them, right?
Yeah.
That said, I don't know if there's a room for 11 products to exist. I think there's a room for a big number of these, and they'll try to differentiate themselves in what they do and what they offer and how they market themselves. But we're likely to see a handful of these close over the next year or so.
Well, just to rephrase the question, because I am curious about this idea that if we do have an ETF setup that effectively makes it easier, and I guess in some cases, if they keep these fees where they are, cheaper to buy through those ETFs than doing it directly here, is that going to, I guess, bring in new entrants who maybe we're a little bit skittish about going through the whole process of what it takes now to buy crypto?
Yeah, I mean, what these ETFs are targeted at two main people. I mean, a little bit to retail, right? That's obviously going to be the end goal no matter what you do, but it's really targeted at the advisor market. The advisors own about 2/3 of the ETF assets. Currently, the market is about $8 trillion in AUM for US ETFs. So these ETFs are targeted at that market who are never really going to buy Bitcoin futures ETFs because they're not an efficient way to get exposure, particularly with these fees coming down so low. And those types of investors aren't going to be putting like 20% or 50% of their portfolio in here. They're going to put a slice, 2%, 3%, 5%. So this is going to be their hot sauce on top of their basic boring portfolio. And the other people this is going to be targeting is the institutions that are restricted to holding only securities or bonds or what have you in their documents when they were created. A lot of them, they physically have no way legally to hold Bitcoin. These ETFs will put Bitcoin in an ETF wrapper, which makes it a security, which makes institutions, which I'm not saying there's a whole bunch of billions or trillions of dollars waiting in the wings, but there are likely some that are interested and might start dipping their toes in the water because the ETFs exist, particularly with fees as low as they are, and especially if these ETFs become as liquid as we think they can.
All right, well, the countdown begins. James, always great to talk to you. James Seyfert over at Bloomberg Intelligence has been all over this story, and we'll talk a little bit more about it later this week, depending on what that decision ends up being. Coming up here on the program here on this Monday afternoon, a discussion here about the rights to broadcast National Basketball Association games set to expire in 2025, and streaming companies are hoping to get a big piece of that action. That discussion coming up after the break. This is Bloomberg.
It's been about a decade since the NBA was at the bargaining table to determine who televises its games. Now, in the U.S. right now, you can watch NBA games on ABC, ESPN, and TNT, which is owned by Warner Brothers Discovery. But those rights are set to expire in 2025. So here with more now is Bloomberg News global business reporter Ira Boudway. And Ira, when the NBA last negotiated, it came up with a combined $24 billion value for these TV rights, these live rights. Are we expecting similar numbers in just different format this time around?
So yeah, I mean, their haul was about $2.7 billion a year with the last package, and that was a tripling of what had gone before. So what everybody's looking at is, can they do something like that again? And the people I'm speaking with are saying tripling will be tough this time around just because of the climate in media, but they might get there. And then what they're going to have to do is sort of split the rights probably among a bigger group of partners, probably including some newcomers, maybe one of the tech giants.
Right, because companies like Disney and Warner Brothers are in cost-cutting mode. They can't afford to pay triple what they were before. So when we talk about these tech companies, these new entrants, what do we know about how they're positioning themselves for this?
It's interesting because right now, Disney and Warner Brothers Discovery are sort of exclusive. The negotiating window officially begins March 9th. They have a 45-day window where they are exclusive in the talks. But it's clear that the likes of Alphabet, Amazon, maybe Apple, maybe Meta, others would be interested in some kind of package. So probably what will happen is the league will divide up the rights in a new and different way. And they'll slice it and dice it. Maybe you have a Friday night exclusive for Apple. Maybe you take their new in-season tournament, which they started this year and was fairly successful, and give that to, or sell that to Amazon. And then you keep still ESPN and TNT in the mix because they are gonna want it, they still need it, and people are accustomed to finding them there.
Well, some people. I mean, we should point out, I mean, the NBA has become, in terms of its broadcast, has become very fragmented to a certain extent. We've seen other sports even get more fragmented than that. And when I hear you sort of lay out the potential scenario, that even seems more fragmented to me. So I understand why that might be good for the NBA, it might be good for those streaming companies. As a viewer, though, is that going to be good for us?
Yeah, I mean, this is just the way of things right now. You look at this weekend, for the first time, the NFL is going to do an exclusive streaming game for the playoffs on Peacock.
Right.
And that is because for Peacock, that's
nobody has.
incredibly valuable to get people to sign up. If you're a fan, that maybe feels onerous, right? You have to look in more places, have more logins, keep track of more subscriptions.
But here's the thing: there's a new generation of folks out there who never turn on a television set, including at least one person in my household. It just would never even occur to them. Everything they do is going to be through their phone, through the internet, and the streaming services that are fed through that, rather than going through a cable package like a TNT or something else like that here. Is that going to be taken into account in a more meaningful way, or are they really willing to sort of bet on broadcast for a few more years, partially, with the expectations that that could be a bridge to whatever the next contract may be?
I mean, I think they're going to try to manage that transition, and you're going to see it in a few ways. They will start bringing in streamers in the way that the NFL, MLB, every other league has done it when they've come due with their national rights. You will also see their traditional legacy media partners move towards streaming models. ESPN, probably by the time this deal is up, is going to be putting its flagship station over the top as a streaming subscription.
I wonder how much that becomes a point of discussion. Because one of the reasons why I can't watch a lot of this stuff is because a lot of these companies are still wedded to those cable contracts where they legally can't even show what we want to see on a streaming platform.
Right, and so I think what happens is the likes of Disney are going to say, we want to have the right to do whatever we want. We want to be able to put these games on our internet products and on our legacy products, and that's going to be a big piece of the conversation.
All right, Ira, of course, a lot of people are going to be keeping an eye on this. Ira Boudouet, a closer look here at negotiations set to start this year on a new NBA contract here with broadcasters, whether it's here in the U.S., or on the streaming side. All right, coming up here, we're going to talk about the murky waters of AI, a discussion about AI ethics with Meredith Broussard. That's coming up next. The first trading week of the new year put a little bit of fear in the hearts of a lot of investors, but the start of the second trading week may be providing a bit of encouragement. Most of the major indices clawing back most of their losses from last week, with the S&P 500 up 1.4% on the day, the NASDAQ up about 2%, even the Russell getting involved in the action, up almost 2% on the day as well. This is less about the macro stories, a little bit more about the technical, but to a large part, it is about the individual fundamentals, the idea that there is value to be found, value outside of that Magnificent Seven, value outside of those big cap tech stocks, whether that is cyclicals, whether that is small caps, or whether, quite frankly, it's just some of those mid cap players that had been largely ignored for the last year and a half. Maybe, just maybe, they could finally get their due. Scarlett?
Yeah, everything else in the S&P 500 but those Magnificent Seven. Well, speaking of the Magnificent Seven and the tech world overall, much of that tech universe will be gathering together in Las Vegas for the annual International CES conference. You've got more than 130,000 people attending that four-day event. And of course, artificial intelligence will be front and center of most conversation and exhibits. For more on what to expect, we're joined now by Bloomberg's Austin Carr, who joins us from Boston. So, Austin, I guess AI is going to be the theme of this year's CES, the way that smart gadgets were the theme a couple years back?
That's correct. I mean, it was pretty much inevitable. Every year there is one trend that everyone coalesces around. You know, years ago it's 3D printing, 3D television. Some years it's Internet of Things or voice-powered gadgets. But AI, just given the year that ChatGPT, Midjourney, Microsoft, a lot of the big players in the software space have had in the artificial intelligence industry, we expect that to translate to the hardware space, where we haven't seen the equivalent gadget take off and really take over a consumer electronic in much the way the iPhone had back in 2007. So I think that's going to be the big thing. Everyone's watching this. What gadget stands out in the AI realm, and what sort of form factors are going to sort of capture the AI software in a way that we haven't seen before with traditional hardware.
Do you have any sense, though, what that's going to look like? I mean, we talked last week about Microsoft putting that AI key on the board, and we all kind of snickered, like, I don't know, what does that do here? I mean, is there something more substantive to that, or is this just going to be more optics?
I think that's TBD, and that's where we're going to be looking at this conference for what is more buzzword and what is more legitimate improvement with technology. To your point about sort of Microsoft adding a single key, I think we're so far seeing a little bit more toe in the water steps toward AI. So far we've seen AI being added to televisions, AI being added to smart home appliances, AI being added to toothbrushes, or I even saw a grill at CES that has been marketed with AI. And I think we're really going to have to separate between sort of the more gimmicky features with the ones that hardware could really bring these software sort of services to life using actual hardware.
Austin, very quickly, final question to you. What kind of consumer demand is there for these AI gadgets, or is it more build it and they will come, hopefully?
I think it's build it and they will come, but just given that Amazon, Apple, are all sort of racing toward this market. We saw, a company as well capitalized as Humane just a month ago. I think they raised something like $700 million, come out with their AI pin. So there's a lot of questions about, what is going to be the big winner of these sort of AI features as they come to physical form factors. Yeah. But I think right now it's sort of a buzzword until we see more legitimate, tangible uses of this technology and hardware.
All right, Austin Carr, Bloomberg News here. A look here at maybe some of the hardware gadgets that we could see focus in on AI and the software, of course, behind it. But it raises a lot of questions that if you do buy that new Microsoft keyboard and you hit that little AI button, what's the result that you get? How accurate is it? In fact, whether it's going to be biased or not. There's a big story out there that has been developing among some of the news publishers out there involving OpenAI and companies like the New York Times. 2 journalists from the latter have filed a copyright suit against the startup. But OpenAI says that the Times isn't telling the full story. Let's get some perspective out of our next guest. Meredith Broussard is Associate Professor over at NYU's Arthur Carter Journalism Institute. She's also Research Director for the NYU Alliance for Public Interest Technology, author of several books, including Artificial Unintelligence, How Computers Misunderstand the World. A data scientist, a former journalist, you're a person after my heart here. Let's talk a little bit about this, because there's always this idea, no matter what you're doing with the data, whether we're talking about this newfangled AI or the old data spreadsheets of old, you put garbage in, you're going to get garbage out. There's been a lot of talk about this lawsuit and about where OpenAI and its competitors are getting their information, where they're getting their data, and are they compensating the folks who actually developed that data and developed that information?
So the LLMs, like ChatGPT, are getting most of their information from the New York Times, from the U.S. Patent and Trademark Office data set, and from Wikipedia.
Okay.
So they have all of the companies who train these LLMs have admitted that they are training the models based on a finite, or a couple of data sets have an outsized importance in training these models. And so OpenAI is nothing without the New York Times data.
It's nothing, and it's funny that you put those 3 together, because when I look at Wikipedia, I mean, look, we all use it as a resource, but we all know, always take it with a grain of salt, because who knows how reliable some of that information is. The patent office thing is new to me. I think most people kind of look at the New York Times as being kind of emblematic of good journalism. I mean, that's debatable, but certainly that seems to be the consensus here. If that somehow goes away, or if they don't strike a deal with the New York Times, are they going to be in a position where if they lose that resource, they have nothing else to go on?
Well, the problem is that when you are training an AI model like this, you are scraping all of this data off the internet. Basically, they're strip mining the internet.
But it's not their data.
It's not their data. It's out there publicly. And so we are thinking about it in terms of copyright, but I think we need to extend our thinking not just about copyright, it's also about mineral rights, right? Because what OpenAI and the other companies are doing is they're strip mining the internet for data the same way that you would strip mine for something like coal. And then they're not having human beings use the content to innovate, to create something new. They're taking the content, they're putting it in machines, and the machines are making something new. Well, we already have law for that, right? We have law around mineral rights, right? And when we think about, okay, we're going to use something like coal and put it in a machine and generate something new, we have this understanding that you need to pay the person who owns the land where the coal is.
Gotcha.
And so this is another way of thinking about what's happening with the content that OpenAI and other companies are scraping off of the internet.
So there's got to be payment at some point, in other words. Have any of these large language models ever asked for permission to use the content or the data from sources like the New York Times? I mean, have they ever attempted to talk about payment?
Well, there are some payment deals being negotiated. We can think about who's paying for news in general, and we can think about the actual content deals that are being negotiated for the large language models. So OpenAI has struck a deal with Axel Springer. They have struck a deal with the AP in order to use some of the content in ChatGPT. So they're not averse to paying. I suspect that what's going on in this particular suit is that OpenAI is not offering to pay enough. Right. And there are actually numbers about what is the value of news. There's a new report out of Columbia University that came out this year. Some economists looked at what is the value that Google gets from news in the United States. And Google, they estimate, is earning about $30 billion from news content. So if ChatGPT were not to be able to use news content or rely on New York Times content, they're losing out on a whole lot of money. So this whole issue is about money. Right. It's about not wanting to pay for the raw materials.
That $30 billion. So does that account for AI, or is that kind of pre-AI?
That was pre-AI.
So what would be the model to use in terms of looking for some kind of number? If the issue comes down to perhaps OpenAI was not offering enough money, what do you use as your base case?
Well, I mean, I'm a journalism professor. I think that journalism is worth a lot of money. And so whatever they were offering to pay, I think they ought to offer to pay much more.
Okay, this gets us now to, I guess, the broader question as to whether they will do that. We know that a lot of these tech companies, they have that whole ethos of just moving fast, break things or whatever the phrase is, and deal with the consequences later here. But between this lawsuit, the potential for regulations, you use strip mining as an example. We know that there's already been one potential proposal to expand the copyright laws to include some of the fast data gathering that some of the online news services would be a part of here. Do you think there is a viable regulatory or legislative solution that could be done relatively quickly?
We are in a really exciting time for regulation. We can look to the EU, and we can look at the EU's AI Act, which is being enacted. The EU is actually a little bit further ahead of the US in terms of regulating AI. But here in the US, we have the executive order on AI, which I think is really promising. It directs the various government agencies to develop a policy around AI. And there are also some voluntary agreements in place around AI that I think are really promising. So for example, the big AI companies have agreed to label their content as being generated by a human or generated by an AI, which is great and will help with the misinformation crisis. It will not fix it, but it will help a tiny bit. And so that's a step in the right direction. It's not a big enough step, but it is a step.
But you've played around with some of these consumer-facing AI bots and things like that. I mean, we all have, and we've all kind of had some fun with how wrong some of them are. I am curious, though, just as a journalist, as a journalism professor here, do you envision that we will get to the point where we will be able to look at that information coming out of these AI bots as reliable, that we'll get enough confidence that what they're pushing out is accurate, or at least as accurate as can be?
Well, there's actually no way to ensure, as of this moment, there's no way to be sure that the bot is not hallucinating. So people want to trust these machines. People have this persistent fantasy that we're going to be able to replace human beings with machines. And they sort of imagine that there's a little brain inside the computer, and it's just a machine.
But that's
it's just a bunch of poison rocks.
Because I put into one. And just if you do just factual stuff, say like, okay, when was the last time the S&P dropped 5%, or basic things that we talk about on the show all the time that are easily verifiable. I get completely wrong answers, at least based on what I would get just typing it into the Bloomberg.
That's how these things work. They're unreliable. There's absolutely no way to ensure that they are giving you what's true. Because the way these machines work is a lot of them use popular as a proxy for good, right? So a computer can't determine what is good or true. It can only determine what is popular.
Just like high school.
Exactly, which is very unfortunate.
All right, Meredith, great to talk to you. Meredith Broussard, she's an associate professor over at New York University, the author of several books surrounding AI and data collection here, including Artificial Unintelligence, How Computers Misunderstand the World. Stick with us here on The Close. A lot more coming up, including a closer look here on that potential government shutdown. At least for right now, we might actually be able to avoid it. We're going to get some insights out of Tobin Marcus, who heads the policy and politics team over at Wolf Research. That conversation coming up next. This is Bloomberg. Over the weekend, U.S. congressional leaders announced an agreement on top-line spending for the current fiscal year. Now remember, this is basically tying up the loose ends from last year. The deal does reduce the odds of a partial government shutdown, which would come on January 20th if a deal is not struck. But there's still lots of negotiating ahead before we get there. Joining us now from Washington is Bloomberg Balance of Power co-anchor Kayleigh Lyons to update us here on what we know. Kayleigh, should I be encouraged? What do we know?
Well, it is encouraging that they have come to this agreement on top-line figures, but Romaine, this agreement is basically just a re-agreement of the debt ceiling deal, the Fiscal Responsibility Act that was struck between President Biden and then Speaker Kevin McCarthy all the way back in May. These numbers are pretty much in line, around $1.6 trillion, $773 billion in terms of non-defense discretionary spending. Maybe some conservative wins for Speaker Mike Johnson in terms of $16 billion in cost savings that come from a pulling forward and reducing funding for the IRS by $10 billion. And rescinding $6 billion in related COVID relief spending. But still, a lot of conservatives in the House, like the House Freedom Caucus, don't seem super happy with this deal. So that is one challenge. The other challenge is that this is just the top line numbers. Those top line figures still have to be divvied up between all of these different government agencies and written into actual legislative text. And we know that, as has been in the past with these funding deals, often it takes Democratic votes to get it over the finish line. And that could be something of a problem for Mike Johnson, considering it was passing funding bills with Democratic support that got Kevin McCarthy ousted in the first place. The other complicating factor in all of this, Romaine, is that there are many House conservatives who are pushing for a government shutdown if they don't get what they want in terms of border security policy. And that border security deal is being negotiated right now between the Senate and the White House. It's unclear what the House particularly will sign on for, when a lot of House Republicans are pushing for H.R. 2, a very conservative bill they've already passed that was dead on arrival in the Senate. So that kind of adds to a complicated picture here, let alone the other supplemental funding requests for the wars in Israel and Ukraine, Romaine.
Kayleigh Lyons down in Washington. You can check her out immediately after the show, 5 p.m. Washington time, as co-host of Balance of Power. We continue our conversation here about the potential for that government shutdown, the potential for averting that shutdown as well. Tobin Marcus, head of policy and politics at Wolf Research, joining us right now here in New York in Studio 2. And Tobin, you heard Kayleigh talking about some of the top line numbers, those top line agreements here. It's one thing when I see, Mitch McConnell or Chuck Schumer or even Mike Johnson say, oh, yeah, we got a deal. What I really want to hear is really like the crazy fringe of the Republican Party and whether they're actually going to go along with any of this.
Right. So at the end of the day, their votes are not going to be needed. This is going to pass, on suspension in the House with more Democratic votes than Republican votes. The question is there an appetite for them to actually go into kind of open revolt against Johnson? Thus far, we're seeing a lot of belly aching. We're notably not seeing a lot of explicit threats. They're not saying they're going to try to oust Johnson. They're not, even really being that concrete in terms of what it is that they want him to do. But I think his questions are primarily within the Republican caucus and within the conservative movement.
If we do end up in a situation where we get a repeat of what we saw with Kevin when he basically struck that deal, right? And it was a sensible deal. I think most people in hindsight can see here, but obviously it led to an ouster of his job. Is there enough, rancor right now in the Republican Party that we could see a repeat of that should this bill, at least as we know it to be now, ends up becoming the law?
Yeah, I don't think we will for a couple of reasons. One, Johnson kind of has his roots in the conservative movement, has a lot more goodwill. He's spending down that goodwill pretty actively, but he came in with more, certainly. And I don't think that there is much appetite for another fight over replacing the speaker. That really did not go well for them. But I do think it changes Johnson's calculations in terms of what he's willing to do, whether he gets cold feet, what they end up doing in some of the remaining fights between here and the finish line.
Right. He does have to tread pretty carefully. So I guess the question is, how willing is Johnson to work with Democrats? And by the same token, how willing are Democrats to work with Speaker Johnson?
Yeah, I think Democrats are happy to go along with this as long as nothing unexpected crops up between here and the finish line. There has notably been divergence in the way that the two sides have talked about what they agreed to in terms of policy riders, so sort of non-fiscal provisions on abortion, on border security that might get attached. Johnson has said to his caucus, this deal puts us in a great position to keep fighting on policy riders. Democrats have said, essentially, we've already agreed, no poison pills, no policy riders. So that, I think, is a big open question that could blow up the deal from the Democratic side. But failing that, I think they're perfectly happy to supply all the Democratic votes in the House that they need to get things done at these funding levels. They see it as, largely a win to have stuck to the debt ceiling deal spending levels from earlier in the summer with no big new gives.
So assuming that they all agree on these top lines in place, is this enough to avert a shutdown? Because a lot of stuff still has to happen before January 19th.
Yeah, so I think there's a couple different kinds of shutdowns that are still a possibility. There's the version of this where the deal actually blows up because there's some conservative rebellion, because the deal blows up between Democrats and Republicans over something that's outside the scope of the top line funding agreement. The other possibility is just that they run out of time and that we have a very short shutdown. Not a lot of market consequences, I think, in that situation. If basically everyone agrees the numbers are sticking, but they actually just need more time to process the bills. Obviously, we do not have a lot of time between now and January 20th. So a sort of short shutdown between January 20th, when the first agencies run out of funding, and February 2nd, when the remainder do, strikes me as meaningful possibilities. Still.
This all could, of course, prove to be academic. I am curious, though, about how much appetite the American public has for this. Is this a real election issue? I mean, how much are regular people actually paying attention to the ins and outs of what's going on in the budget?
Yeah, I think very little unless we get a blow up. We're talking about $22 billion, 0.5% cut to non-defense domestic spending, 3% increase to defense. Those are not numbers that are going to be noticeable, I think, to ordinary people in the course of their day-to-day lives. So it's really a question of, does this blow up? Does one side or another do something that's kind of patently unreasonable? And right now, it looks like we're not headed for that, but of course, the possibility remains.
All right. Well, of course, a lot to sort out over the next week and a half or so. Tobin Marcus, head of policy and politics over at Wolf Research, look at the developments in Washington on finding some compromise here on a budget that should have been passed months ago. Stick with us here. We're going to set you up for what the markets will have their eye on over the next 24 hours. This is Bloomberg. All right, a busy start to the week. Let's look ahead over the next 24 hours, Scarlett. And we're going to start off with Boeing. That was the story today, and it could be the story tomorrow as well.
Yeah, David Calhoun had to cancel a senior leadership retreat to really gather the best minds in the company as they deal with the fallout from the Boeing 737 MAX 9 jets and the fuselage that came apart in that Alaska Airlines flight.
Yeah, a big safety meeting scheduled with employees for tomorrow. We'll have full coverage of that. Of course, we'll be all over any developments in approval of a spot Bitcoin ETF. Is it going to happen tomorrow?
I don't know if it's going to happen tomorrow. It should happen by Wednesday. So we're on the lookout for any kind of filings, any kind of updates. We've already got the fees. So at this point, it's word from the SEC.
Absolutely. Here, we'll keep an eye on that. We're also going to keep an eye on the Consumer Electronics Show, now known as CES. A lot of interviews scheduled to come out of that.
Right, including the CEO of Qualcomm, Cristiano Amon, will be joining us at 12 p.m. Eastern time on Bloomberg Technology. That's a big name. And of course, we'll be updating you throughout the day with more conversations.
The ARM CEO also scheduled to make an appearance, as well as a few others. So definitely tune in for that. We also get some earnings tomorrow as well, including out of Samsung and Albertsons.
Samsung and Albertsons. Samsung, of course, in Korea. Albertsons here in the U.S., giving us a look at the grocery business. Also, Tilray. Remember when cannabis was the big thing?
Yeah, cannabis was a big thing. But have you actually looked at some of the cannabis stocks? They've been sort of slowly creeping up over the last few weeks here. Not quite sure why. But yeah, I remember that was all the rage. And now
the AI of the past.
Yeah, absolutely here. And we get a big Treasury auction tomorrow. It's something to keep an eye on. 3-year Treasury auction, 1 p.m. New York time. Thanks for joining me and Scarlett today here on The Close. We'll be back tomorrow. In the meantime, stick around. Balance of Power is coming up next here in the U.S. Have a great evening. This is Bloomberg.